Is the Santa Claus rally overpowering Fed pushback? Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Katie Greifeld. Kicking you off to closing bell here in the U.S. You take a look at this equity market, and we do have yet another rally on our hands. The S&P 500 up by about 0.6%. You take a look at the NASDAQ 100. Big tech up even more, up about 0.7%. And Scarlett mentioned that Fed pushback, maybe not making a dent in the equity market, but you are seeing a little bit of a sell-off come into the bond market right now. 10-year yields currently up about 4 basis points, but of course we're still below that 4% level. And I did just want to focus on crude a little bit. Of course, we are seeing a little bit of a rally build here. It's continuing today. Crude up about 1.7%, Scarlett.
And of course, when it comes to the markets, Powell spoke, markets rallied, and now we're getting the walk back. Chicago Fed President Austin Goolsbee is the latest central bank official to strike a more cautious tone when addressing market expectations of rate cuts. He follows New York Fed President John Williams, who last week called bets for a March cut premature. Is this the last hurrah of M&A before the year end? More than $40 billion of deals hitting the market on Monday, including U.S. Steel, which will be acquired by Nippon Steel for a hefty 142% premium to when the company first began its strategic review. But we want to go back to the market action, which, Katie, means zeroing in on Fed speak. And comments by U.S. central bankers may be tempering investor optimism, but they're not exactly derailing the everything rally either. In fact, most assets holding on to the majority of their gains,
including equities. You take a look at the S&P 500 up again today, and that's after it closed down on a 7th straight week of gains. We're talking about small gains, but still gains nonetheless. And you can see that is the longest streak going back to 2017. So clearly a lot of optimism in the air. And it's actually been interesting to watch this rally really broaden out. It's not just big tech. And you take a look at the NASDAQ 100, of course, the big tech benchmark. And actually, we've seen a rebalancing, and we know that the big 7 stocks, those weights in the NASDAQ 100, they've actually been going down. You can see the changes here from December 15th to December 18th. Of course, these are still the biggest stocks by weighting, by then some, but you can see still going down nonetheless, Scarlett.
All right, let's put this all into perspective here and bring in an expert. We've got our market analysis now with Elena Hernandez. She's a principal at GenTrust. Elena, good to speak with you. You heard what Katie was saying about the rebalancing within the NASDAQ, some of the magnificent sevens weighting, at least in the NASDAQ 100, coming down. Yet you look at the markets today, especially in equities, and it's as if none of the central bank officials spoke to push back what Powell was saying. Is the Santa Claus rally overpowering the Fed pushback?
I think so. I think there's a lot of forces into play right now with, to your point, the Santa Claus rally. I think some short covering happening too. And of course, we know, and we have to be, mindful that we had a lot of money going into short-term treasuries as rates sold off and people could get paid for keeping sort of cash, if we want to call it that, in hands. And we know some of that money has gone into the equity market recently too.
To what extent are lower rates starting to, how much were high rates priced into the markets, and where do you see the pricing of lower rates or the lack of higher rates being priced through most efficiently across equities?
Yeah, so we think it's interesting what has happened in terms of, the effects of higher rates pricing to the market. So on one hand, you have the commercial real estate market and U.S. small cap market pricing in, right, the effects of higher rates for, higher borrowing, et cetera, et cetera. But then on the other hand, you have the credit market, which if we look at spreads for both investment grade and high yield, they're tighter today than they were when the Fed started its, one of the fastest rating cycle, if not the fastest we've seen in March 2022. So we think there's inconsistencies in regards to areas of the market that are fully pricing in the effects of higher rates, and then other areas that haven't really, incorporated that. Another sector that we're watching closely, and I know we've talked with you about, is commercial real estate, not only for the particular sector of commercial real estate, but also for the potential, risk going into financials, right? We know financials hold a lot of the commercial real estate loans. And in particular, the interesting point is that only the top 25, so about 50% of the commercial real estate loans are held by banks. Of those, only 14% are held by the top 25 banks. So a lot of risk is still put on the regional banks, which is, an area that we are still cautious of. I know we saw some unfortunate events in that sector in March this year, but we expect a little bit more pressure as the higher effects of rates keep pushing through the markets.
And Elena, just to tie a bow on that point, of course, you take a look over the past month and a half or so, and financials are one of the areas that's doing really well. You think about the CRE concerns on top of that. It sounds like you're saying this isn't necessarily bad for the financials sector overall, but maybe some caution around the regional banks, the smaller banks.
Yeah, I think you're right. I mean, you will see potentially, right, if we go into a slowdown or a recession, which, by the way, we just published our 2024 outlook, and we think there's a higher probability that we'll go into an economic slowdown/recession than the market is pricing in. But to your question, we do expect the spread of financials to potentially widen, or financials to trade less strongly, but particularly the regional banks, right? To give you a stat that I thought was really interesting, of the 1.8 trillion of commercial real estate loans that are coming due, i.e. they have to pay them back in the next 4 years, regional banks particularly hold about a third, and that percentage goes up to 50% in 2026, 2027, according to the MSCI. So there is a big risk on that sector, and we've been, and we continue to be very cautious on it.
And Elena, I also wanted to go back to what you said about corporate credit. Basically, that if you look at investment grade, if you look at high yield, the effect of higher rates hasn't yet been priced in to the same extent as maybe that you're seeing in small caps. But if that repricing hasn't happened by now, do you think that it's going to happen at all now that you're seeing rate cuts getting aggressively priced into the market?
Yeah, so we disagree a little bit of where the market is in different points. Like, we think it's going to be very hard to go and have inflation at the Fed's target at 2% if we don't have a slowdown, a recession, right? So that's number one. Like, we don't expect the rate cuts to come in unless we have a slowdown in the market, which obviously then should push us wider in spread or lower in the equity market. So the 150 basis points of cuts that's priced in for next year, we don't think that's achievable unless you have a slowdown. And we think, obviously, in a slowdown, then all these other effects of high rates and delayed reaction of the higher rates in the market would be seen in both equity and then, in a correction, potentially in the fixed income markets, too.
Yeah, we can't forget of the long and variable lags there of monetary policy. Thank you, Elena. Really appreciate it. Elena Hernandez of GenTrust. Now, coming up on the close on the big show, it might be M&A Monday, but not for Adobe, which is walking away from its $20 billion acquisition of software maker Figma. What led Adobe to give up on the deal?
Plus, BP will pause all shipments through the Red Sea after more attacks on merchant vessels. We'll have the latest on what the tensions could mean for energy prices.
And Harvard sees a drop in college applicants, early college applicants. Is it all due to tensions surrounding the Israel-Hamas war? We'll talk with Nat Smitobol, a private college admissions counselor at IvyWise. All that and more coming up. This is The Close on Bloomberg. Merger breakdown. Shares of Adobe on the move today to the downside after the firm announced that it is walking away from its $20 billion acquisition of startup Figma after clashing with regulators in Europe and the UK. Adobe actually higher right now by 2.5%. Bloomberg's Brody Ford has the story. And Brody, it's been, I believe, 15 months since Adobe said it was going to buy Figma, and now they've said they're giving up. What exactly happened?
Yeah, I mean, 15 months will wear you down, right? A year and a half ago, it seemed that Adobe really had its back up against the wall as it relates to the creative market. There was a sense that these young rivals like Figma and Canva were really kind of starting to encroach into its territory. There was a sense it needed to kind of do something to reaccelerate growth. And that was Figma. They paid a huge price, right? $20 billion. I think a lot of investors liked the idea of the deal, but they thought it was too expensive. And then as Adobe's share price has gone up, it's become even more expensive. And so essentially, the regulators really said to Adobe that they are concerned that this is another instance of a large tech company snuffing out a young competitor. And since things are a little different for Adobe today with the AI and they have a lot of other growth drivers, my sense is that they all figured it was not worth all the trouble.
And Brody, it's really interesting to see Wall Street's reaction to this. As Scarlett mentioned, shares are higher right now of Adobe. And there was a really interesting note out from Evercore, the title of which was "No Figma, No Problem."
Right.
Where does this leave Adobe going forward?
In the short term, I got a story coming out how they have $6 billion to do what they want with now on their balance sheet, right? They can invest in AI faster. They can do buybacks. Hey, they could buy somebody small, right? So I think investors are excited in the short term to have this capital free, be able to invest elsewhere. But what's interesting is that while investors are happy in the short term, long-term questions remain, right? Figma is a capable company. It is growing somewhat in the direction of Adobe's core portfolio. Investors are scared of these competitive concerns in the long term, but that's a 2024 problem.
That might be a 2024 problem, but I'm glad you bring that up because now that they are separate, but they have gone through each other's books, they've done the bulk of the due diligence, so they know each other's backstory really, really well. It's like the world's most awkward breakup. How do you move forward from that as potential competitors when you know so much about each other?
Yeah, and Figma, I saw a tweet, right? Congrats to them. They raised $1 billion with no dilution. Right? I mean, Adobe had to pay them $1 billion to walk away here. And yeah, so it's going to be a little awkward. You know, I think that they probably are going to have partnerships and talk about how they're going to be friends after this. But the biggest question that remains is, are the two companies on a collision course in the way that the regulators feared, right? I mean, does Figma in a year say, we need to expand our portfolio and we're going to make a Photoshop competitor. We're going to make an Illustrator competitor. Are they going to merge with Canva, right? I mean, I don't know. There's a lot of different scenarios now that can happen. And as you said, it's going to be a bit of an awkward breakup.
All right, well, it's going to be fascinating to watch. Know that you'll be all over it. Our thanks to Bloomberg's Brody Ford. Now let's stick with M&A. The topic of the focus, rather, of the latest Bloomberg Big Take, all the tough road ahead for the about $1.3 trillion deal boom that we've seen. Bloomberg's Nina Trentmont co-authored the story and joined us now. And Nina, some really great reporting went into this piece. I know that you looked at 75 of the largest acquisitions over the past 5 years. Walk us through some of the main takeaways.
Thanks for having me, and happy to. So we found that less than half of companies managed to cut their debt levels to the degree that they promised to. We also found that almost a third of companies had leverage ratios above 3.5 times, and we also found that average leverage ratios were higher. So basically, companies were too optimistic going into those deals, took on too much debt, and are now faced in this situation of higher interest rates, slowing economy, of how to bring the debt down.
And it's interesting, you have some specific examples in here. You focus on Walgreens Boots Alliance. Of course, they bought Summit Health City MD about a year ago, and it's been interesting to see how that's been handled by the rating agencies.
Yeah, so we recently saw that Walgreens was downgraded to junk the first time since the company's creation. The company is now considering to divest its UK arm Boots, which it had been in discussions for before, but then decided to not do that because of the offerings that it received. There are questions about this health care service push that Walgreens has attempted, and this is just one of the companies, I think, where sort of just the combination of factors is the problem. And we also have some other examples in the story, looking at, for example, Bayer Monsanto and also Oracle Cerner, where basically companies are still in the process of deal making or are already hitting these roadblocks. Bayer Monsanto, of course, is a well-known case where the company just underestimated the volume of litigation that would come with buying the weed killer owner.
I want to go back to one of the main points you mentioned, which is less than half the companies you've examined have managed to cut their leverage ratios since their acquisitions. Why is it so difficult? How come it's so difficult for these companies to bring down their debt?
I think it's to do with the timing. So the fact that they took on potentially too much debt, plus also then that there is, of course, a limited time window during which they have agreed to bring down leverage. So the goals were potentially too ambitious. Plus, they're doing that at a time when you have slowing spending from consumers, you have slowing spending from governments, from businesses, and therefore sort of the overall economic backdrop is not necessarily helping. Like, we've been waiting for a recession here in the US for a long time. It hasn't necessarily happened, but still we've seen spending decline. And so one good thing for the companies, one has to point out, is that ratings firms so far have been pretty lenient with them. So we haven't necessarily seen a huge amount of downgrades, apart from, for example, the Walgreens example. So we've been finding that ratings firms have actually given those companies a lot of leeway to achieve the targets, which should hopefully be beneficial for them, assuming that they get to achieve their targets.
That's a good point. I guess the question then becomes, how much of a problem will these high debt loads, relatively high debt loads, be for companies in 2024, now that we've finally heard from the Fed that they're ready to pivot?
Yeah, so I guess some of these companies might be breathing a sigh of relief because they're anticipating that the Fed will cut rates next year, which could make it easier for them to refinance. We are expecting a fair amount of refinancings to come to the market. So those companies that borrowed cheaply in 2020 during the pandemic, many of them will have to refinance next year. And so some of these companies that did do deals will likely look at that as well, with the prospect of potentially lower interest rates that could take away some of the pressure. But in the end, sort of some of these M&A deals that we looked at, they're facing like fundamental problems in their M&A. So I think strategic issues will not necessarily be taken away just by the easing of financing cost pressure.
All right, Nina, really appreciate you joining us today. Nina Trentman with, of course, the big take, Bloomberg News' examination of the $1.3 trillion debt-fueled M&A boom that is getting a bit of a reality check, Katie, because even though refinancing costs will likely come down now that interest rates are no longer rising, you also have regulators, of course, keeping a very close eye on everything and dragging things out in a way that perhaps people didn't anticipate either.
Yeah, reading this story was a really important and a good reminder that even though interest rates are poised to come down, they're not coming down yet. And then you have, like you said, the issue of regulation concerns, also the fact that just making the M&A actually make sense is something you also have to do as well.
Yeah, making the case to investors in the market, right?
Yeah.
Okay, coming up, BP will pause all shipments through the Red Sea after more attacks on merchant vessels. We're going to have the latest on the tensions next. This is The Close on Bloomberg. BP said it'll pause all shipments through the Red Sea after attacks on merchant ships escalated. This route is crucial for many economies, accounting for 12% of global seaborne trade. Now, U.S. Defense Secretary Lloyd Austin is convening with fellow ministers tomorrow virtually to address this problem. So we'd like to bring in now Bloomberg senior diplomacy reporter Ian Marlowe in Washington. Ian, is this something that diplomacy can solve when you have attacks by Houthi rebels backed by Iran?
Yeah, not really. I mean, this is something that has been difficult for the U.S. to grapple with, in part because the Houthis are backed by Iran and are considered, at least in the region, sort of one of the less predictable and less amenable to diplomatic overtures, in terms of groups, armed groups. With some others, there's been some back channels they can have. They're obviously, the U.S. is trying to halt the civil war and in Yemen anyway, and so there had been some discussions with them, but the U.S. had already moved military assets into the region to deter Iran-backed armed groups from attacking either Israel or U.S. assets in the region. And so it's something more that they are looking at. This is why Austin is talking about this issue more than, say, Secretary Blinken on the State Department side, because it is something where they think, you need naval assets in the region to sort of deter these ships. And obviously attacks on commercial shipping in that part of the world have been a longstanding concern even before these latest round of attacks.
Yeah, I'm glad you bring up that context, that this is something that's been a longstanding concern. Just how much more escalation have we seen of late compared to what we might normally see around this time of year?
Yeah, I mean, I think you've obviously seen a huge escalation. The Israel-Hamas war has prompted a lot of Iranian-backed groups to do what they can to try and hit at Israel and the U.S. And so the Houthis, given their position across this, crucial shipping lane, this is something that they have decided to do. I mean, they say they're targeting ships with links to Israel. And so you've seen a dramatic increase in attacks in the last few weeks. Late last week, we saw some major container shipping lines start to halt shipments through that corridor. And today, obviously, you're seeing BP and some energy companies do the same, which has hit oil a little bit. So it's obviously something that's escalating in terms of risk. And the proximity of this threat to global trade more generally and energy specifically is something that obviously has the U.S. on a heightened edge. The one flip side to this is that the U.S. is slightly constrained in terms of how they can react, because they don't want to just launch another front, in what is already a very combustible region and combustible situation. So they don't want to, launch armed strikes onto, into Yemen, and kind of give them what they want in the sense, because some of these Iran-backed groups actually get their, street cred burnished a little bit by tackling the U.S. and prompting a reaction. So there is some sort of balance that the U.S. is trying to strike here, and that's partly why Austin is trying to convene others and ask other nations, like say Australia or others, to try and send ships to the region to deter others. So it's not just a U.S.-focused thing, but also that there's enough ships to create a sort of deterrence factor and prevent some of these attacks from happening.
And Ian, just quickly here, you mentioned, of course, this is a very dangerous, a very delicate situation, but the fact that we're talking about potential disruptions to global trade, how much urgency does that add to this situation?
Yeah, I mean, I think definitely it adds a ton of urgency, because some of the diplomacy around Israel and Hamas has been difficult and lengthy. You've seen certain things like pushing for getting humanitarian aid, into Gaza has taken a very long time. It's an ongoing issue. There's ups and downs. I think with something like this, like we saw with Ukraine and Russia in the past, when war and conflict and energy and global trade start to mesh, this is where sort of U.S. sanctions, the Treasury Department, the Defense Department gets involved, and some of these things are a little bit more, it's a little bit more granular and concrete than just diplomatic negotiations. There's ships that need to be moved around, and there's a lot of T's that need to be crossed, and the rest of it.
Ian, really appreciate your giving us all the context on this. Bloomberg's Ian Marlowe in Washington. This is The Close on Bloomberg. This is the countdown to the close. Let's get your check on where commodity markets close as we see equities continue to build on their post-Fed rally. Take a look at the energy complex, whether it's WTI crude, natural gas, or European natural gas. We see gains across this space on supply disruption fears. BP and other oil companies are hitting pause on shipping through the Red Sea because of a series of attacks on vessels in the region. And European natural gas in particular surging the most in 2 months, up more than 7%, even though there's no shortage fears because of milder weather. Normally, you'd expect those shortage fears to really percolate right now, given what's been happening in the past. And I'd like to throw Bitcoin up there, Katie.
Interesting.
I mean, it's commodities close, but is it a commodity? Is it a currency? It's an eternal debate.
It sounds like you answered that question by putting Bitcoin up in there. That's pretty interesting. Not a great day for Bitcoin, but let's stay in the commodity space. A surge in U.S. shale production could pose a threat to OPEC. U.S. forecasters predicted shale production would average 12.5 million barrels a day during the current quarter, but in recent days, that estimate was bumped up to 13.3 million. Now, the difference is the equivalent of adding a new Venezuela to global supplies. Bloomberg's Kevin Crowley joins us for the latest from Houston. And Kevin, it seems like OPEC Plus and the U.S. shale industry, they're kind of working at cross purposes here.
That's absolutely right. The US is really surprised to the upside this year. Last year, there was big concerns over the productivity of shale wells that they were going to drop. That hasn't happened. Quite the opposite is true. Actually, productivity improved even further. It was a number of small technical factors, but taken together, they've had quite a big impact. And the second thing that's happened is the role of the private producers. They've really been accelerating growth since COVID. In fact, 7 of the top 10 growing producers by volume since COVID have been private producers, and they are by their very nature much harder to model.
And so what is the potential OPEC response here to the fact that you do have the U.S. shale production booming right now? Of course, I think everyone's scared about a 2014 sort of episode, of course, when OPEC really flooded the market with supply to sort of check the influence of the U.S. industry. Is anyone saying that we could see that again?
Look, it's certainly a possibility. As you said, it happens in 2014 and it happened again in 2020. Now, it's probably more difficult to happen now because the shale industry is in a much stronger place. There's been a lot of consolidation. They've paid back a lot of debt, so there aren't so many smaller, weak companies. These companies are now growing. By way of their own cash flow. They're not growing by debt anymore. So it's a much stronger industry, much harder to wipe out. So I think OPEC would be quite cautious about doing that, about dropping the price of oil to such a level that they would try to wipe out the industry again. So really it puts OPEC in a bit of a bind. The cartel reduced by about 2 million barrels a day at the most recent meeting. Now there's been a doubt over whether they can do that. The US added 1 million. So the US has taken away about 50% of that cut just in this past year. So it really remains to be seen if OPEC does respond to this.
To what extent can the U.S. maintain this level of production growth? I mean, can we model out that this is what's going to happen down the road?
So the US can definitely maintain this level of production, around 13 million barrels a day or so. Can continue that out for a decade or more. Whether they can maintain that levels of growth is another question. Probably not. The forecast for next year is that the US will maybe grow by about 300,000 to 500,000 barrels a day, which would be about half the levels of this year. But it's a very dynamic industry, and they could surprise us again.
Kevin, how united, how aligned are OPEC Plus members when it comes to confronting the U.S. production boom? I mean, we've heard how some of the OPEC Plus meetings have not gone over very well. Saudi Arabia wanting one thing and then the other countries kind of resisting, and they having to delay the actual meeting and having to do it virtually. It's a lot messier than we realize.
It has been, yeah. And we had at the last meeting, we had an OPEC member actually say that they were not going to follow the cuts that they had been offered. That was Angola. It was quite a remarkable statement to come out in public like that. And I think look, over time the answer of OPEC really to confront U.S. shale is really to expand the alliance. We saw them bring in Russia a few years ago, and most recently they've announced an alliance with Brazil. Now there's no talk of any barrels being cut as a result of that, but I think that's more the move now to really balance the market in this new environment where shale is really dominant. I mean, it's worth remembering now the U.S. is producing over 13 million barrels a day. That's nearly 50% more oil than Saudi Arabia, which bills itself as the central bank of oil. The sheer scale of this U.S. production is really unprecedented.
Well, Kevin, it's a fascinating trend to watch with some big implications. Really appreciate your reporting and insight. That is Bloomberg's Kevin Crowley. Now, still ahead, it's the year of NVIDIA. We'll analyze the chipmaker's performance in a year dominated by the AI frenzy. This is The Close on Bloomberg. Time now for top calls. We'll look at some of the big movers on the back of analyst recommendations. And we start with a firm downgraded to underweight over at Morgan Stanley. The analyst says that although a firm is well on its way to becoming a bigger player in the payment space, it's clear that the market has gotten ahead of itself, adding that their valuation seems difficult to justify across all metrics. You take a look at the shares, though, up about 1.3%. Next up, Raymond James clicking the escape key on Palo Alto Networks with a cut to market perform from from Outperform. The analyst citing a stretched valuation and an expected plateau in financing receivables, all pointing to a less favorable risk reward in the cybersecurity stock. You take a look right now, currently, I'll call that unchanged. And finally, we have Snap grabbing a picture-perfect upgrade to buy from neutral over at Guggenheim. The firm expects that Snap's revenue growth to outperform in 2024, driven by strong digital ad demand. Also, the price target jumping up to $23 from $9. You take a look at shares right now, only up about 0.7%. And those are some of our top calls. Now let's stay in the tech space and talk about the sector's breakout star. Of course, we're talking about NVIDIA. Artificial intelligence propelled the stock's valuation to over $1 trillion this year. But what does 2024 look like for this chip maker? For more, we turn to Stacy Rasgon. He is managing director and senior analyst covering U.S. semiconductors for Bernstein Research, and he has an outperform rating on NVIDIA shares. And Stacy, given that outperform rating that you have, it seems like you think this momentum is going to continue.
Yeah, look, I think numbers for now are going up, probably up materially. Demand right now is off the charts. They don't have the ability to supply like anywhere near where the demand is. Now, we can argue about sustainability, and it's kind of funny. Like if you look at the stock's like more than tripled this year. And in fact, the multiple has actually come down even more. It's actually the cheapest of all the AI stocks out there. It's cheaper than AMD. It's cheaper than Marvell. It's even cheaper than Intel. And the reason is the numbers are getting so big so quickly. People are worried about that sustainability, right? And I kind of get that. We can talk about it. But in the near to medium term, over the next, probably these 12 months, maybe more, my suspicion is the numbers are much more likely to go up than down. I think the valuation has already come down. I think it's extremely attractive here. And I will be honest, I am incredibly bullish long-term on the opportunity here, both around AI as well as around the broader opportunities around accelerated computing. And I'm still convinced we're looking out 5 years, 10 years, we'll be talking about numbers that are still materially higher than the numbers we're talking about today.
Okay, so you make a good case, especially when you point out that it's actually cheaper than some of the other AI stocks.
Yeah.
But people who want to have exposure to AI don't want to put all their eggs in one basket and only be exposed to NVIDIA, because what if something happens? What if Jensen Huang gets hit by a truck, for instance?
God, let's not.
Right. So what would be the next best alternative? I mean, if everything else is expensive, where do you go to just get some diversification?
Well, let's talk about the options. I mean, the natural one that people are looking at is AMD, right? Because I mean, they've got a roadmap with products on it, and they've given some numbers. And they actually, by the way, they did this very smartly. They gave a number when they reported earnings a month or two ago, and they said, we think we'll do more than $2 billion of AI revenues next year. But it was not a good quarter that they had. I suspect if they hadn't given us a number, the stock would not be nearly as strong as it has been. But they've given people a narrative to latch onto. They've actually left room for those numbers to come up, because $2 billion is not very much. All of it in the grand context of things, it's a rounding error. Like, let's say they do 2 or 3 or 4 or whatever it is. Yeah. Like if NVIDIA were to do 70 next year, it'd probably be viewed as disappointing. So I think there's a view that no matter what number AMD puts out, they can hit it. Okay. Right. And I think there's a desire to be able to play this sort of a theme with less perceived, call it like air pocket risk. Although I'm not actually sure that if there really was a real air pocket, that anybody would be spared. But that is sort of the perception. And AMD, like I said, to their credit, they've left room, I think, for that narrative to continue. And that's what people would like to see. And so clearly people have been buying the stock on that theme. Okay.
So there's a lot of messaging here that's taking place. I know we mentioned Jensen Huang getting hit by a truck, and hopefully that doesn't happen. But is there an issue with key man risk here for NVIDIA?
And look, Jensen's a pretty remarkable individual, and he is the heart and soul of NVIDIA. He's in his early 60s, I think. It doesn't seem like he's going anywhere, though. But I mean, clearly, you know, Jensen and NVIDIA are sort of viewed as kind of one and the same. Yeah, I wouldn't want to see Jensen go anywhere, sure.
Okay, so maybe key man risk, not a huge concern. What about geopolitics when it comes to NVIDIA? You think about the U.S. And China, the relationship there, export controls. How are you modeling that into your very bullish NVIDIA forecast?
Yeah, you bet. So people are worried about China because, like, as of right now, they can't ship anything really into China. The new export controls are fairly constrictive. and they effectively block every product that they were shipping. And these ones are more difficult to work around than the prior ones that were put into a year ago, which were fairly easy to work around. Now, that being said, it does look like NVIDIA is developing new products that ideally will be legal to sell into China. They will be much lower performance than what they're currently selling, but they will be software compatible. And my view was look, right now there's enough demand from everywhere that I don't have to really worry about China. And they're able to backfill that demand clearly with, even though it's gone, they've got other folks that are lining up to buy those parts. With some of the new products they're developing, I would say maybe we don't have to completely write off China. I would say, though, over the long term, I think you do have to view the China TAM as potentially being impaired. I think it was going to happen anyways, though, whether or not new export controls were put into place. Because I think about it this way, even if these performance thresholds were never lowered, they were never going to be raised. And so over time, the gap between what was legal to sell in China versus elsewhere was just going to get bigger and bigger and bigger and bigger anyways. And so what their ability to sell stuff in China was going to get less and less competitive anyways. And so I think this may pull forward that point, but over time it was going to happen. I still think the overall market, China right now has been about 20% of their data center sales. I think even if you check what you thought the overall opportunity was in 5 years or 10 years and haircut it by 20%, it's still big.
All right, Stacy, that's a good note to leave it on. Really appreciate your time. Great to speak with you. That is Stacy Rasgon over at Bernstein. And that was a really interesting point. You think about the total addressable market in China. It was never going to go up. So maybe it was already baked in that it was going to go down.
Yeah, and of course, you have to consider China as a closed market right now because of all the tensions between Beijing and Washington and how China is going to respond to everything. I was just looking at the management structure of NVIDIA to see who else has been at the firm for close to as long as Jensen Huang has been there. He's been there for 30 years because he is the founder. But you do have two folks who've been there for 15 years, the executive VP of Worldwide Field Operations and Operations. I'm not saying that we need to look for alternatives, but if you're thinking about succession, it's never too late to start grooming people.
It seems like investors do love to focus on succession, so we'll see if that becomes more of a narrative, of course, as NVIDIA continues to climb. $1 trillion valuation. We'll see what happens next year. But coming up on the close, higher costs, political tensions, and a dwindling pool of applicants are altering the higher education landscape. We'll discuss how the class of 2028 will fare as they make their enrollment decisions. This is The Close on Bloomberg.
High-performing high school seniors may be falling out of love with Harvard because they've submitted 17% fewer early admission applications to the university this year. So that takes the level of this early interest to a 4-year low, according to figures released last week. Let's get an update on demand for elite college admissions with Nat Smitobol. He is a private college admissions counselor at IvyWise. Nat, it is good to speak with you, and I'm curious to get your take on what's going on at Harvard when UPenn, which has also been in the spotlight over its handling of anti-Semitism, saw early applications increase this year.
Sure. Yeah, we see an overall increase, and that's something that I was expecting, given the, in a post-SCOTUS decision landscape. I did expect for application numbers to increase at some of the more uber selective universities. And you're right in pointing out that Harvard was, it's a noteworthy decrease in applications, down 17%. And also another college that was in the news a lot with all of the conflict was Brown, and Brown also was down just under 8%, 7.7% in this year's early applications.
So you bring up the Supreme Court ban on considering race for college admissions, and what's been noted is that a couple of elite schools like Cornell have made it clear that they're going to admit fewer people in the early decision round because they want to be more equitable through the regular decision round. Is that something that you're seeing across the board?
Oh, not necessarily. I think every college is still looking for their own way to try to diversify the class. And I think, admitting a smaller number in ED is one way to do it. I think we're also seeing colleges, use their supplement, maybe a specific question in trying to gather diverse applicant pools or trying to gather diversity within their enrolled student body without breaking the law. So it all depends on what strategy the college has tried to use in order to remain diverse, in terms of enrolling the class.
Gotcha. What is the takeaway so far from what you've seen with the early admissions, whether it's early decision or early action? Most of the responses have already come in.
Yeah, this increase in numbers is still, for me, it's scary. I worked at a college admissions office. I was at Skidmore College in 2009. And I remember that year was supposed to be the peak in terms of high school graduation numbers. And so all of my colleagues at other schools were talking about that. And then 2010 came, 2011, and all the subsequent years. And you still see this increase in applications. And that is by design. That's by the college's design. They still need an increase in applications every year in order to remain selective or increase in terms of the selectivity.
And let's talk about from the student's perspective, applying to college. I'm looking through some of your notes. This is a really interesting point that students are applying to longer lists of schools in the past. It was a huge relief for me. I applied ED to Haverford College, so just stopped worrying about it pretty quickly. But now these lists, they tend to have 20 or more schools. That really shocked me.
Yeah, I think that in this landscape, when you don't know what's going on, when there's a lot of uncertainty, it's almost intuitive to apply to more schools, to shoot more arrows, to try to land one on the target. That can be counterintuitive. I think the students that I'm working more closely with, we're just being more thoughtful about our application strategy, and that usually does not mean applying to a larger number of schools. But nationwide, right, this also is part of the disparity. Not everyone has access to college counseling. And so I think the gut reaction is, oh my gosh, it's gotten so much more selective. Mm-hmm. I think I have to apply to more schools.
Yeah, that's a really good point. It can get really expensive, but for some students who do have a fee waiver, it just becomes something where they would check boxes off, but they also have to write more essays. So, Nat, as we wrap up our conversation, I'm curious to see whether you see any linkage between the responses universities have had to the tensions on campus, the threats from donors to withhold donations or gifts, or at least in some cases actually withholding donations, and students' interest in applying and eventually enrolling in those schools?
Sure. I think it's too early to tell at the moment. In Westport, my community, we have a significant Jewish population, and I have a lot of friends who have kids that are applying to colleges. So I think empirically, I'm hearing that it is causing students to think about where they want to apply and where they want to be for the next 4 years, where they feel more safe, where they feel more included. But I think it's still too early to tell if it's going to make, a serious decline or a serious change in overall application numbers.
One last question before I let you go. What school is seeing the most unexpected rise in interest? I keep hearing Southern schools are more and more popular now.
Yeah, I would say the Southern schools are doing well, especially the tri-state area. I think larger state universities are doing well overall. And that is, that's trouble for, that challenges the pipeline for smaller liberal arts colleges.
Gotcha. Nat, really appreciate your joining us. Nat Smitobol is college admissions counselor at IvyWise, joining us from Westport, Connecticut, where I'm sure there's plenty of demand for private college admissions counselors. Yeah. It's a sport there at this point.
I mean, I'm still stuck on the fact that you have these high school students applying to 20 or more schools. That is so many. I think back, 15 years ago, not to reveal my age or anything, when I was applying to high school, I mean, maybe it was 10 if you were like really ambitious, but really 5 to 8, it feels like was the sweet spot.
And on top of that, if you've got 20 schools, each school has like 2 supplementary essays. So that's 20 times 2. That's 40 essays that you're writing over the holiday break.
That's why I did ED. I just didn't want to do that much work. Thank God I got in. But yeah, geez. And then you think of the costs on top of it. A good point about fee waivers. But if you don't have them, those application costs really add up quick.
Yeah, absolutely. And I think people just kind of consider that a sunk cost in all of this. We'll just eat the cost of whatever it costs to apply to these schools, and we'll see what happens. Like shoot our arrows in every direction, and maybe something will
throw spaghetti at the wall, see what lands.
Yeah.
What do you make of the fact that Southern schools are so popular?
Yeah, that's an interesting one. I don't know if it has to do with sports or maybe they're not in the headlines these days with all the tensions on college campuses and people just want to get away from what is happening here.
Yeah, it's going to be fascinating to see where all of this ends up, I don't know, in what, 10 years, 20 years from now?
Well, for now, for the kids who are applying, just, come March, they need to get some kind of answer. All right, we have just over an hour to go before the close here. We are looking at a rally somewhat in equities. The S&P up 0.6%. The NASDAQ, I believe, at a record high. This is the close on Bloomberg. It's just about 3 p.m. in New York. This is the countdown to the close. Let's get a view from the top. I'm Scarlett Fu.
And I'm Katie Greifeld.
And if you look at where markets are trading right now, there's life before Powell's pivot, and then there's life after Powell's pivot. And after Powell's pivot, it's a lot to get through. Fed official after Fed official have come out to walk back some of the dovishness. It hasn't really done anything to dent the rally in stocks.
Yeah, not so much. You can see the S&P 500 looking at gains again today. We are on record close watch. I believe we're not quite there yet.
Spitting distance.
Spitting distance, just a kiss away. But maybe it's having a little bit more of an impact, that pushback in the bond market. You're looking at 10-year Treasury yields up about 4 basis points or so, but still below 4%.
Below 4%. It was, at 5% in late October.
Yeah.
And of course, the Bank of Japan starts its 2-day meeting today. The big question is how much it's going to signal a shift away from negative interest rates. But this is something we've been on watch for, it feels like years, and it has yet to happen.
But maybe it finally will.
Maybe it finally will. And I wanted to take a look at how that shift away from higher rates for the Fed has affected the rest of the market, particularly some beaten down sectors. If you look at this chart that shows how financial stocks and real estate investment trusts, REITs, have done, you could see that the share of financial stocks and REITs that are trading above their long-term trend line, above their 200-day moving average, has gone up. It's now at the high since the Fed rate was 0.25 percentage point.
And this really gets to what we've been talking about, this broadening out of this rally. You think about where we've been going since late October. It hasn't just been big tech. Of course, you are seeing other sectors, other types of names participate. Let's get to some of the individual movers today, though, because we do have quite a few of them. I did want to start with United States Steel. Of course, the news there is that Nippon will buy U.S. Steel for $55 per share in cash. This has been kind of a dramatic process. Now we are finally getting to the tail end of it. You can see U.S. Steel, which has the very cool ticker X. I'm sure Elon Musk would like that one eventually. Shares up about 26%.
Maybe he will now that Nippon Steel is buying it. I know,
That's
a question.
A black market for stock tickers.
So what happens to Cleveland-Cliffs, which of course had made a bid for U.S. Steel and now was rebuffed and now is independent still?
It is aggressively pivoting to share buybacks, coming out Cleveland-Cliffs announcing an aggressive share buyback program. Of course, this is just months after they made that ultimately unsuccessful takeover bid for their rival U.S. Steel. That didn't work out. But, investors like share buybacks. You can see that shares are up about 10% at the moment. So everyone is happy here, at least for now. Not happy, though, is SunPower. This is a rooftop solar company having a terrible day. This is after it breached a credit agreement and said that there is, quote, substantial doubt about its ability to continue operating. If you take a look at shares, they fell as much as 41%. That was the worst plunge ever. Some of that has come back, but still shares down about 31%, Scarlett.
I really like the way that they say it, some substantial doubt. It's not the same thing as we might go under.
Exactly.
All right, we're less than an hour away from the closing bell. Cross-platform coverage starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Scarlett Fu and Katie Greifeld here with you. We are joined now by our colleague Tim Stanovic, who is on his own in Bloomberg Radio.
It's just me.
Hi, Tim.
Wow.
Hi, how are you guys?
Are you okay?
I'm fine.
Okay.
I'm doing well, yeah.
All right.
I think, yeah,
well,
we're
we
good.
missed your partner in crime, but we're glad you're able to make it.
I'm glad I get to check in with you every hour. You can kind of do this like wellness check, make sure I'm doing okay.
Talk you through it.
Okay? Yeah, I appreciate that. Hey, I don't know what you guys have on your holiday list this year, the Christmas list. Do you have the new Apple Watch on your list?
I have the Apple iPhone that I'm hoping someone will get for me, but not the Apple Watch.
Okay, if you're listening, Santa Claus, Scarlett wants a new iPhone. Well, those who do want the new Apple Watch for Christmas, this is the Series 9 and Ultra 2 in the US. You better hope that whoever was going to go buy that for you, including Santa Claus, has already gone out and bought it, because the company's going to stop selling the latest version of that smartwatch here in the US. Guys, all of this comes down to a patent dispute. And that means the watches are going to be taken off the market during a really, really important quarter for Apple here in the US. It's this anticipated import ban of Apple Watch models that have this blood oxygen sensor on them. That sensor is at the center of a legal battle with Masimo Corporation, which also makes devices that do similar readings.
Yeah, so the devices, they will be removed from Apple's online store at 3 p.m. New York time on Thursday, so you can go and look at it, I guess, until then. But
Apple play with it at the Apple store.
Exactly. Go touch it while you can. Apple said, of course, there will be no impact to watches already sold to customers, but
they're not going to confiscate them.
Exactly. You can keep it. It is a pretty amazing story. It's amazing to think that there will be people walking around with these watches on their wrists.
Yeah. Well, and fortunately, they're thinking, thank God I got my stuff done early. You know, I'm kind of grateful that I didn't do any of my holiday shopping yet, because VF Corp, which is the owner of Vans and North Face, has seen some cyber incidents on its website, on its IT system overall, and some personal data was taken as a result. So if you were buying Vans for someone in your family, you better check to see if maybe your data has been breached.
It's not just Vans. It's North Face, Timberland, Dickies, Supreme, JanSport, and more. This is a Denver-based company. I was just going to say, Scarlett, I mean, I'm sure the closets in your home are filled with Supreme. I didn't know people could buy that stuff online. I thought you just like line up for it for the drops. Is that big in your house, Scarlett? Supreme?
Vans are. No, not Supreme.
Vans are, okay.
Yeah.
Yeah.
All right, maybe I'm dating myself here. I thought
maybe you are.
I actually know what teenagers think is actually cool. Hey, this disruption though that we're talking about when it comes to these cyber threats, we're increasingly seeing this. And again, just like the Apple Watch news, it couldn't come at a worse time, Katie, for VF Corp. It actually comes on a day when we're seeing a new rules and disclosure requirements by the SEC all around cyber attacks that actually go into effect today. Wendy Thomas is the CEO at the cybersecurity company SecureWorks. She's going to be joining us a little bit later on the program to give us an idea of
how
you
said us,
publicly.
Tim.
Oh, us. She's going to be joining me.
Okay.
A little bit later.
On Bloomberg Radio, specifically.
Me and all my imaginary friends.
The royal we. Yeah. Well, that sounds like a great conversation, because to your point, I mean, it's really been industry agnostic. You think about some of the big names this year. I believe Clorox, MGM, now VF Corp, falling victim to these cyber attacks. And for VF Corp, I mean, this is ongoing. The company hasn't yet determined the full scope of this incident, and it's going to show up in their earnings.
It's a good point that we should make, that brick and mortar shoppers are unlikely to be impacted. So if you are desperate for some of those items, Timberland boots, North Face jackets, you can still go to the store and you won't be impacted. Just don't get it online.
Not really want people who waited to the last minute to do their holiday shopping.
No consolation there whatsoever.
Not at all. Hey, that's going to do it for now, but I will be back with you a little bit under an hour.
Royal we. It's okay.
Check in with me. I think I'm going to be okay. We'll be here live on TV, radio, and YouTube. Also on Bloomberg Originals, 4 p.m. for our Beyond the Bell coverage. That's when we take you through today's market close. We'll see y'all in a little while.
And of course, you'll want to tune in at the top of the next hour when we check in with Tim again. But in the meantime, we want to go back to our market analysis here as we look at a day in which equities continue to build on their recent gains, with the exception of the Russell 2000, the S&P 500, of course, eyeing a record high. Let's bring in now our next guest, Shamaila Khan. She is UBS Asset Management America's head of fixed income, emerging markets, and Asia Pacific. Really good to speak with you. Thank you so much for joining us today.
Thank you for having me.
So give us a sense of what the Fed pivot means for your asset class and what your clients are asking you about now.
Absolutely. Look, if you look at the volatility that the market experienced because of Fed policies this year, despite that, emerging markets performed broadly in line with other global fixed income assets. EM investment grade was similar to US investment grade, and the same for high yield. What it really means for 2024 is that we may potentially be entering a period of better financial conditions for emerging markets. It's broadly positive. But in addition to that, there have been a number of other factors with respect to default rates peaking, EM growth getting supported by EM central banks starting to cut rates, commodity prices higher, that are also supportive for emerging market performance in 2024.
What about the currency component? You mentioned if these EM central banks start cutting rates, that would reduce the appeal of their currency. But we've seen right now how the dollar is losing ground because of the expectation that the Fed will be the first to move.
We are expecting most of the performance to come from EM local rates rather than EM FX, so to really remain stable. But the EM carry in certain local market is still very attractive relative to other assets.
And talk to us a little bit about emerging market central banks. Of course, over the past week and really the past year, all the focus has been on the Fed. But you think about emerging market central banks, they were really out in front when it came to the rate hiking cycle. Now that we're entering, it looks like the opposite end of that phase globally. Where do they fall when it comes to rate cuts and easing?
They are going to be continuing to ease. They were earlier in the process than developed market central banks, but we feel that there is more room for them to continue to ease rates, and that's going to be positive for the local market performance, but also for growth in emerging markets, which we think is going to be better supported than developed market growth, with the differential between EM growth and developed market growth widening.
And when we talk about emerging markets, of course, it's a very broad term. Where are you seeing the most opportunity when you look at a region level, at a country level?
We're seeing the best opportunities in the distressed countries that no one really liked at the beginning of the year. We were doing deep analysis, stress tests on these countries, and we realized that the market was overpricing the risk of default. These countries have really been some of the best performing assets, not only in global fixed income, but in global financial assets. And no one really liked them at the beginning of the year.
Of course, when we talk about emerging markets, too, many of them are either producers or consumers of commodities. And with the disruption that we see in the Red Sea and the ascent of oil prices once again, how is that impacting how you think about which countries look attractive or which kinds of company bonds look attractive?
Yeah, we think that commodity prices have been and will remain in a higher range since 2020, really. And we like the commodity exporters, the countries that are exporters of oil as well as metals and select high-yield exporting companies.
And I am curious, I mean, we're talking about emerging market fixed income here. Does this view apply to sovereign debt, to corporate credit as well? How are you thinking about the different types of fixed income?
I would say that this particular year, as well as going into next year, in terms of the distressed debt, it's really mainly in the sovereign space. But the EM corporate space has really been, for a longer-term investor, a good risk-adjusted return as well. But for the very near term, if you're looking for higher risk, higher returns, EM sovereign hard currency debt, as well as select local markets, are the best place to be.
All right, that's a good place to end it. Shamaila, really appreciate your time. Thank you for joining us on set. That is Shamaila Khan. She is UBS Asset Management Americas. Coming up, we'll hear from our interview with Michael Sonnenshein, CEO of Grayscale. His insight on when the SEC could approve a spot Bitcoin ETF.
2024, right? That's the thinking?
Theoretically.
Okay, theoretically. Plus, the latest on who could potentially succeed Jamie Dimon. He's 67 years old, but he shows no signs of wanting to step down. So the question is, will he retire as chief of JP Morgan Chase anytime soon?
Some big questions. We'll try to get some answers. And as we head to the close, we'll get insight on the markets from Megan Horneman. She is Chief Investment Officer at Verdence Capital Advisors. All that and more coming up. This is The Close on Bloomberg.
About 45 minutes to go before the close of markets on this Monday. And even as Fed officials push back a bit here on the market's optimism over the timing of Fed rate cuts at some point in 2024, you could see that the S&P 500 is overall higher by 0.5%. And in terms of the big gainers, the stocks are contributing the most to the index's gains. You're looking at a lot of big tech names. Apple up by 1 2/3%. You've got Nvidia gaining almost 0.9%. Amazon up by about the same. Netflix also gaining about 3.7%. In terms of laggers on the S&P 500, there are some drug makers declining, including Pfizer, off by 6.7% as it sees a price target cut to $32, as well as Adobe after its deal with Figma has fizzled out because it couldn't get the regulatory approval it needed in Europe and the U.S. But I do want to put everything in perspective here, because while equities are seeing a bit of levity here with the S&P 500 inching closer to matching a record high, you are seeing some selling in treasuries. The 10-year yield moving up to 3.95% right now. We're still below 4%, but perhaps the bond market is listening a little more closely to the likes of Austin Goolsbee and some of the other Fed officials who are talking back, walking back some of the dovishness that Jay Powell unleashed at his news conference last week. Katie?
I don't know. I kind of like to think that they were talking back to Jerome Powell. It injects a little bit of drama into the conversation. But we pivot from the bond market over to crypto, because as the clock ticks down towards the potential U.S. launch of spot Bitcoin ETFs, the CEO of Grayscale is arguing that multiple issuers should be allowed to launch their products at once. I spoke with Grayscale's Michael Sonnenshein earlier today.
We will lower fees upon conversion. I feel like as optimistic as I've ever been about getting closer and closer to the GBTC uplisting based on the conversations we've been having with the staff around the mechanics that underpin spot Bitcoin ETFs. But we will have to wait until we get all the regulatory approvals before announcing what that new fee will be.
I take it to mean we'll apply at launch that lowered fee.
Yeah, the first day that we see GBTC uplisted to the New York Stock Exchange as a spot Bitcoin ETF should carry that new lower fee.
And why wait? Why not just lower fees now while GBTC is still a trust?
Well, right now our actually main focus is really just on the conversion itself. So one of the things that I think is so important in this conversation around spot Bitcoin ETFs coming to market is that the conversation has really graduated from really only focusing on that underlying spot market, which is really where we were spending our time with the staff, to now instead really focusing on the underlying guts and mechanics of getting the SEC comfortable with how these products would actually function in market. So this is priority number one for my team, for the firm, and obviously for hundreds of thousands of investors across the US.
JP Morgan, in a recent research report, wrote that speculation that GBTC will actually convert into an ETF, that's fueled a lot of this inflow. And as a result, $2.7 billion could exit after the fact as investors take profit. So that's the JP Morgan view. What's your response?
So my view and my team's view is that the arrival of GBTC as a uplisted spot Bitcoin ETF, as well as spot Bitcoin ETFs more generally, is actually the beginning of an opportunity for the advised wealth market in the United States. That's about $30 trillion of wealth that, by and large, has not had products that they can go into to obtain spot Bitcoin exposure. Now, as you said, GBTC has been a very popular investment vehicle for investors of all shapes and sizes to get regulated Bitcoin exposure, and many of them are doing so today, right? We've seen the discount on GBTC narrow considerably this year as investor optimism around its uplisting has continued to take place. But I think for us, we certainly see that there's a lot of pent-up demand in that advised community, and we do think that GBTC, as well as other products, will actually experience a lot of that inflow upon conversion, upon uplisting.
Are you preparing, though, for the possibility that the JP Morgan hypothetical scenario plays out and you do see substantial inflows after conversion?
There are multiple Bitcoin futures ETFs on the market, and we've been prepared for a world in which there are multiple spot Bitcoin products on the market. Ultimately, I do think investors should have choice when it comes to that. And the differentiators that I already know will be in play for GBTC are its 10-year track record, its billions and billions of dollars of size, and certainly its liquidity, right? There's hundreds of millions of dollars trading in GBTC already every single day.
And of course, that was Grayscale CEO Michael Sonnenshein in conversation just a little bit earlier with me. And we talked about a lot of things. We talked about the timeline. We talked about really the guts, as he called it, of these potential products when it comes to cash versus in-kind. And of course, the flow picture as well. The JP Morgan note that I referenced, that you've seen billions of dollars come into GBTC, just really building speculation on the fact that this will be able to be converted but those investors could take profit and lead to outflows.
More than 10 companies are looking to launch a Bitcoin ETF,
Exactly,
right?
exactly. And that, of course, is one of the conversations that's happening right now. You think about the dozen or so applications standing for spot Bitcoin ETFs. Of course, this was really kicked off by BlackRock in June, coming out and filing for a U.S. spot Bitcoin ETF. That ignited a months-long rally. We know that Grayscale has been trying to convert the Grayscale Bitcoin Trust into an ETF. We'll see what finally happens, because that final deadline is approaching for the ARK and 21 shares product. That is on January 10th next year. But as you heard in the clip, Scarlett, there is a lot of thinking here that maybe there will be a common clock. Maybe the SEC will approve everyone all at once so that they're not playing kingmaker.
Right. They don't want to play favorites here. And thank you for giving me a moment to just drink some water. You mentioned January 10th. Mark your calendars. Did the FTX collapse change anything in terms of how the SEC is looking at Bitcoin ETFs? Or was it just kind of something that happened along the side?
I would say it's more of something that happened along the side. Of course, that really increased scrutiny and criticism of the industry overall. But the products that we're talking about, I mean, BlackRock, obviously, et cetera, all these issuers have done their due diligence. But we'll see. Mark your calendars, January 10th. It'll be interesting to see how the SEC handles this one. But much more coming up. This is The Close on Bloomberg. Well, Ozempic maker Novo Nordisk may have seen huge success this year, but some analysts are doubtful that Europe's hottest stock can maintain its gains into 2024. Of course, Novo up about 42% this year, but 2024, a different ball game. You take a look at the analyst expectations. On average, they see just 9% upside on average in the next 12 months, which, again, isn't nothing, but it's not, 42%.
Yeah, and what's interesting, of course, is I like how you've always framed this whole idea of the Ozempic and weight loss drugs. It's the AI moment for the healthcare space, and we know what AI has done for the big tech space and the chip makers, NVIDIA in particular. It hasn't really lifted the overall healthcare sector. You would think that the group would be flying high, but you look at the performance so far this year for the S&P Healthcare Index, it's not doing too great.
It's fascinating. The healthcare sector overall down about 1.5% this year. If that holds, and we do have a week and a half left of 2023.
There's a Santa Claus rally that's taking place.
Exactly. But if that holds, that would be the second annual loss, consecutive annual loss for the healthcare sector, going back for quite a while to the early 2000s. And that's really because unlike, NVIDIA, et cetera, dragging up the rest of the sector, here you have Novo Nordisk, of course, Eli Lilly, et cetera, really disrupting those other players and making their stocks fall.
Yeah, it's a zero-sum game, right? You're either winning or you're losing, but it's not like the whole excitement over weight loss drugs will lift a Pfizer necessarily, which has its own struggles to deal with at the moment.
Yeah, exactly. It's going to be fascinating to watch in 2024 whether these trends continue. This is The Close on Bloomberg.
We have about a half an hour left in the trading day here, and equities continue to ride the Powell gravy train in that the S&P 500 is getting closer to its all-time high.
Closer and closer, and if we do get there, it's on the heels of a pretty broad rally. That's been the case since late October, and it's the case today. You take a look at the sector level, way more green than red. Up at the top, you have communication services up by about 2.2%. That's followed by consumer staples, consumer discretionary, et cetera. You go down the list, there's really not a lot to pick at here, but in the red, you do have real estate. Then you have utilities all the way at the bottom, Scarlett, but only off about 0.2%.
Yeah, so overall picture is a lot of green there. I noticed industrial is little changed at the moment, but we do have two big movers within that space, notably the steel makers. U.S. Steel, of course, finally agreed to be sold to Nippon Steel for the world's biggest steel maker outside of China. That's what the company will become. In August, of course, it did reject an offer from Cleveland Cliffs. whose stock is also surging today, up 10.5%. And that's because the company has now announced an aggressive stock buyback program after its bid to acquire U.S. Steel failed. Now, we also want to point out Structure Therapeutics, GPCR is the ticker here, down as much as 55%, so it's pared some of its losses. But that's really after the company disclosed trial results showing its experimental weight loss drug was not as effective as a similar treatment being developed by Eli Lilly. The stock, of course, had quadrupled before Friday's close, so this is a little bit of taking money off the table. And VF Corp, I included here, off by more than 7%, down to 1838 after the company said that it is facing some disruption from a cyber attack. It's working to restore its full capabilities to fulfill orders, so the timing for this cyber attack was just awful, given that it's the last week of shopping before the holidays. Unauthorized occurrences were detected on parts of its IT system. Katie?
Well, let's switch gears here and talk about politics, of course, as we count down to the 2024 presidential election. And as we await, President Joe Biden's approval rating has hit an all-time low. That is primarily driven by concerns about high prices and security at the U.S.-Mexico border. That's according to the latest Monmouth University poll. And the latest Bloomberg Morning Consult poll shows that President Biden is trailing former President Trump in 7 key battleground states. Now, as a result, third-party candidates may be emerging as a crucial headwind for Biden, particularly when it comes to younger voters. Joining us now to help break it down from Washington is Gregory Cordy. He covers politics for Bloomberg. And Gregory, of course, every presidential cycle, we do have some third-party candidates emerge. That's a given. But it feels like this time around, they're making more noise and potentially attracting more attention than usual.
Yeah, absolutely. You'd have to go back to Ross Perot in 1992 to really find a field of third-party candidates that's this strong, this early in the process. And it's not necessarily just any one candidate, although Robert F. Kennedy Jr. is the one that is getting the most attention right now. He's polling right around 10% nationally, although some polls have him as high as 20. But you also have Jill Stein, the Green Party candidate, Cornel West, who was looking at the Green Party. Now he's going to run as an independent. And then you have this no labels group that is looking to field a centrist candidate, maybe somebody like Joe Manchin, the West Virginia senator, or Larry Hogan, the former governor of Maryland. Somebody sort of, what's the difference between Joe Biden on the left and Donald Trump on the right?
And Gregory, it's interesting. This is really being cast as a negative, more so for Biden than for former President Trump. Why is that?
Yeah, that's very interesting, and I think there's a couple of reasons. One is that part of President Biden's coalition 4 years ago in 2020 was this group of never Trump Republicans or somewhat right-leaning independents who would ordinarily vote Republican but voted for Joe Biden because they saw him as the lesser of two evils. And then if you throw a third-party candidate in there, then the calculation is they're voting for the least of three evils, perhaps, in their minds. And so you also have more sort of younger voters. There's a generational shift here where younger voters, Generation Z, really isn't beholden to any one political party. They vote on issues and not on candidates or parties, and they're more willing to kind of look outside the traditional two-party system to find a candidate.
What are the issues that these third-party candidates are trumpeting, are pushing? I mean, I know Robert F. Kennedy has this stance on vaccines, which feels less relevant today than it did 2 years ago.
Yeah, that's the issue that he's most known for. He will tell you that that's not his only issue. It's the one he gets asked about a lot because he has some very unconventional and some would even say conspiratorial opinions on vaccines, especially in the post-COVID era. But actually, he's been talking about this for more than a decade. He's running on the environment. He's running on the economy, as every candidate is this cycle. It's really a grab bag. There's no one sort of issue that's necessarily animating all these third-party candidates because they run the gamut of the political spectrum from left to right and in between.
So how are each of the main candidates responding? And here we're talking about, of course, President Joe Biden and presumably former President Donald Trump.
Yeah, Biden and his Democratic Party are very concerned about this. They're particularly concerned about the no labels candidate, that centrist group, and they're very worried that if No Labels does field a candidate that it will hurt Biden more than Trump. And they're trying to make that case to people that if you vote for a third-party candidate, you are helping Trump get elected. And, of course, Trump is stoking that. I think the more candidates, the merrier, as far as he's concerned.
All right, Gregory, really appreciate your time. I'm sure we'll be talking to you a lot in 2024. Our thanks to Bloomberg's Gregory Cordy. Now, coming up, the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg. All right, it's time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's top stories. Scarlett, kick us off. Who you got your eye on?
I am keeping an eye on a former New York Yankee. His name is Alex Rodriguez, also known as A-Rod. He has a blank check company that has agreed to merge with satellite communications provider Link Global. This company is expected to be valued at no less than $800 million. So this is part of A-Rod's Act 2, where it's not something he's been working on. He has been doing this for a while now. Mm-hmm. He's made a lot of investments. He's talked a lot about how Warren Buffett is one of his muses. And the blank check company is something that a lot of former athletes, a lot of everyone, media moguls were doing, a lot of celebrities were doing, and his has come together with another company.
Yeah, I gotta say, reading this, I was like, wow, what? Am I in 2020 again? Like, we haven't heard about a SPAC actually closing something in a long time.
Yeah, so good for him for getting something done, right? We actually spoke earlier with A-Rod about the deal. Take a listen.
We were looking for a category leader with a championship team, and Charles and Link provide both. There's about 1 billion people today that live in rural countries, farmland, foreign countries like the Dominican Republic, where's my homeland, and we get an opportunity to improve their lives, their health, and their economic capacity and ability to make even more income.
So just to backtrack a little bit here, Link Global is working on delivering satellite service to mobile devices from flip phones to the latest iPhone 15 without the use of special equipment. And so they're getting a lot of attention because, especially in remote areas where you can't get great reception, this would be a solution.
Yeah, and it'll be interesting to see how this one plays out. But let's move on to number two, because I'm watching Jamie Dimon, of course. We're talking about...
Everyone is, right?
Exactly. The JP Morgan chief's heir is still unclear as his time at JP Morgan draws nearer to a close. A management shuffle in 2021 put two talented deputies, Jennifer Piepsick and Marion Lake, into the spotlight, but neither has emerged as the clear front runner. And we were talking about key man risk a little bit earlier. Jamie Dimon, he's synonymous with JP Morgan at this point.
He is, and he has often joked about how he's going to do another 5 years, and then when that 5 years comes closer, he's like, oh, I'm just going to do another 5 years. So no one's really been identified as the heir apparent, and in fact, lots of people have left JP Morgan because it became clear that they were not, or Jamie Dimon was not going to step down anytime soon.
Yeah. So we'll continue to watch that one. But who else do we got?
Well, we have one other person that we're watching, and today in particular, it's Trevor Milton. The Nikola founder was ordered to spend 4 years behind bars for lying to shareholders about the electric truck maker's progress, and we're waiting for the sentencing and for more public commentary from him on this. This is something that people have been watching for. You mentioned 2020 and kind of flashback. Like, remember the days when Nikola stock was soaring? That was in the days of 2020, and Trevor Milton was certainly at the center of all that.
Well, for a little bit more context, we're joined now by Bloomberg legal reporter Chris Dolmetsch. And you think about the fact that he got 4 years. Reading your reporting, prosecutors had sought a sentence that was in line with the 11 years recommended by probation officials. What was the thinking behind this sentence in terms of the length of time?
Yeah, so as you said, the prosecutors wanted 11 years in prison. That was kind of in line with what Elizabeth Holmes got in the Theranos fraud. And they really wanted to send a message to other corporate executives who might make misstatements in the press or in the public eye to kind of tamp down that kind of thing. He had faced a whole lot of time under the statutory maximum, which is about 60 years, and as much as 33 and plus years under what the guidelines had. But he has no criminal history. this is a person whose potential punishment was determined almost entirely by the loss amount in the case, which prosecutors allege was up to $600 billion, where the defense said they said there was no loss attributed to his statements, that nobody actually lost money. So there's a wide disparity between what the prosecution wanted and what the defense wanted, which was no jail time at all. And Trevor made a pretty impassioned plea to not get jail time. And it seems like the judge at least, agreed with a few of his points, notably that, that he has no criminal history. He's never done anything like this before, but he still said that he thinks there needs to be a substantial sentence to kind of send a message to other corporate executives.
Yeah.
Even though he said he didn't think he was Elizabeth Holmes or very close to it.
All right, Bloomberg's Chris Dolmetsch, thank you so much for joining us, Bloomberg News legal reporter. And Katie, of course, what was unusual about Trevor Milton's case was that he was not accused of making misrepresented statements through financial statements or anything illegal like that, but through things like social media, YouTube, and a more popular way of getting across to people. So nonetheless being punished for that.
Yeah, and of course this wraps up something that we've been following for a while here, 4 years coming down, again, in line with what was recommended. So interesting to finally see this news break.
All right, we have much more coming up on the close here. Still ahead, we are counting you down to the closing bell. Megan Horneman, Chief Investment Officer at Verdence Capital Advisors, will be joining us next. This is, of course, the close, and we are looking at an S&P 500 that is up by 0.5%. The NASDAQ also at a record high. The NASDAQ Composite at a gain of 0.7%. This is the close. I'm Bloomberg.
This is the countdown to the close. I'm Katie Greifeld with Scarlett Fu. And Scarlett, we have a rally on our hands.
Yeah, is this the Santa Claus rally? I feel
Maybe
like it kind of is.
Yeah.
I mean, it's only a week before Christmas Day, so this qualifies. And you have the S&P 500 gaining 0.5%. Curious, given that treasuries are moving in the other direction, with all these different Fed officials trying to soft pedal, trying to walk back some of what Jay Powell was saying in his news conference last Wednesday.
Walk back or talk back? That's what I want to know.
Definitely walk back. Maybe a little bit of talk back?
Maybe a little bit of talk back. Yeah, it was interesting, of course, to see this play out the way it seems like it always does the days after the Fed decision. Then you get to the parade of Fed speakers, either really putting a line under what the chair said or maybe walking it back. For more, let's welcome in Megan Horneman. She is Chief Investment Officer over at Verdence Capital Advisors. And Megan, weigh in on the past week. Of course, we heard from Jerome Powell last Wednesday, surprisingly dovish. You saw that in the price action. And then we had the pushback starting with John Williams on Friday. Where do you fall in between those messages?
So I think you're right. That speech and the press conference and everything with Powell last week was much more dovish than I had anticipated, and I think most did. So, equities like that, he has to be very careful, and that's the concern that we have. And I think you're seeing that from other Fed officials that are trying to walk that back, is because it's very easy to reignite inflation. He doesn't want to be in this stop and go situation like the 70s and 80s, and we aren't exactly where they want to be with inflation. There still is room to go, and what he's got to battle now is that sticky inflation. The increase we've seen in asset prices now because of this soft rhetoric, this is also inflationary. So I think the Fed's going to be higher for longer. I think you'll continue to see Fed speakers try and put people back into a little bit more of realistic expectations of what can happen next year.
What does higher for longer mean? Does that mean the Fed is on hold here until May, until June, or potentially even longer than that?
Mm-hmm. I think from May to June at a very minimum. I would actually think it might be even the second half of next year. And we'll see what happens with inflation as we go into the next few months. But I think inflation is going to be a little bit harder to get down where they want it to be. Their expectation for the core PCE for the end of next year still isn't at 2%. It's getting there, but it still isn't there. So I'm not sure where all this optimism is and all this pricing in of all these rate hikes. I'm not sure. I don't see where that's realistic for next year.
Yeah, it feels like we're putting ourselves in a position where the markets could be very vulnerable. As we entered 2023, there was a lot of expectation of a recession. Everyone was convinced of it. As we enter 2024, there's overwhelming consensus that we're going to get a soft landing. Everyone seems convinced of it. We know that the recession scenario did not play out. It could be argued that this soft landing economic scenario may not play out either. How concerned are you about the crowded nature of how investors are viewing the economy?
I'm very concerned. It's become a very consensus view that we've been able to orchestrate this perfect soft landing with the most aggressive Fed funds, Fed's tightening cycle that we've seen since the 70s and 80s. You combine that with the fact that banks are still tighter from lending condition standpoint than they were a year ago. And then you have the consumer that's basically just operating on fumes right now. I mean, credit card debt is problematic. Interest rates are still high there, even though they are coming down a bit. The mortgage market, we're starting to see maybe we're getting to some sort of a bottom there, but this has been basically paralyzed for over a year. So I'm not really sure where all this optimism is, especially since it looks like it's holding on all hopes that the labor market will get us out of this. Let's just remember the labor market is a lagging indicator. People typically don't lay off employees until we're well into an economic slowdown. So I'm not sure that we should be holding all of our cards just on the fact that the labor market can continue to remain strong. I think that that's a concern. And this pricing imperfection of a soft landing and the inflation coming down and the Fed done with raising interest rates, concerning to me that everyone's on that boat.
So given all those concerns and where you sit in terms of your caution, talk a little bit about the dry powder that's on the sidelines here. Almost $6 trillion of cash sitting in money market funds that could be deployed, could be allocated to assets. But how are investors or how are clients feeling in terms of their willingness to take risks at this point?
Well, it's just not necessary. I mean, all of these things that I outlined as far as the uncertainty and basically the bar set so high for next year and even 2025, I don't think it's necessary to really be in a rush to get that money to put to work, especially since you're getting paid on money market funds right now. And the Fed has said that the interest rate cuts aren't right away, so there's really no rush for you to have to deploy that money. You're not losing a lot. And we're going to look for valuations to get a little bit more realistic, to come down a bit from a PE perspective before we look to put money to work. Some of the areas that we are looking at, though, the small and mid-cap stocks, they've been big laggards this entire year, and for good reason. I think next year that when we do get through the economic pullback, these are the ones that come out of the recession the strongest. So we'll look at areas like that.
So they come out of the recession the strongest. What happens in the recession, though? How much potential pain could there be for these small and mid-cap companies if we do get a recession before we get to that eventual rebound?
I think there's downside. That's why we're not doing it yet. We'll wait till we get some pullback in those names. They have participated a bit in this rally recently, but over the entire year, it's really just been the S&P 500 or those growth names or technology that's been driving this rally. So we want to see just, I think, a little bit more of a pullback, some lower prices. I think you could get at least a 10% pullback, especially in small and mid caps when the economy really does turn.
Megan, how are you thinking about oil? You mentioned a reignition of inflation where you're seeing oil prices elevated. In fact, the energy complex across the board is elevated because of these disruptions taking place in the Red Sea. Is this something that you think will be a sticking point in 2024 and perhaps could lead to higher inflation overall?
I think we have to be careful with the energy space. We saw energy prices even after the Israel and Hamas war started, that energy prices actually went lower, and that was a bit surprising. You're seeing them turn around now. I think that it's a concern that we have next year, that there could be more supply disruptions, and that's just not factored into the prices right now. From an energy company perspective, energy stocks, but again, laggards this year, there may be some opportunity there. But as I said, we're not really rushing to put any of the money to work yet.
All right, Megan, really great to check in with you. Appreciate your time and your insight. That is Megan Horneman of Verdence Capital Advisors. Meanwhile, we're just minutes away from the closing bell. You take a look at the S&P 500 right now. Small gains, but gains nonetheless. The S&P 500 up about 0.5% or so.
Yeah, and I'm just keeping an eye on that record high for the S&P 500. It was set on January 3rd, 2022, 47.96. That's not too far from here. All you need is another 50 points and we can get there.
The NASDAQ 100 is already there.
Yep.
The Dow Jones already there. The S&P 500, the lone laggard. We are moving closer to the closing bell. Full market coverage right here on Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Scarlett Fu counting you down to the closing bell, and here to help us take us beyond the bell with a global simulcast. We're joined now by just Tim Stanovic. Carl Nasser out this week. Tim, how you doing in there?
I'm doing well. You know, I've had some good visitors in here over the last hour. John Authors from Bloomberg Opinion came by and we had a good chat. Charlie Pellet is in here regularly too. So I got a great crew. I don't want you guys to worry about me at all. Although I will tell you, a lot of our guests have been joining us remotely. I think there's something going around right now. People who were supposed to come into the office and actually be with us on set today, calling in sick, but they're still joining us remotely.
The weather.
Yeah. That too. I mean,
That's
more than 2 inches of rain over the last 24 hours here in the New York City area. Hey, we did just have a great conversation with Jay Jacobs.
You said we, Tim.
We, the royal we.
Maybe he and Charlie Pellet did.
Me and myself had a great conversation with Jay Jacobs. I don't want to say I had a great conversation, but I guess I can say I did have a great conversation with Jay Jacobs. He says that he's over at BlackRock. You guys know him well.
We
he
do.
handles iShares and just heads up thematic ETFs.
Yeah,
he's bullish. I don't know if you knew that.
Yeah.
Even though the S&P 500 is up more than 23% so far this year, he thinks that the cash on the sidelines in those money market funds, the $5 trillion, is going to come back in to the market. But he argues for like a disciplined approach here. There's a high bar, he argues, that people are going to need in order to actually make those investments over the next year.
I know we keep talking about this almost $6 trillion that's sitting on the sidelines, but are people definitely are they necessarily going to put some of that money to use right now when all these equity indexes are at or near record highs?
Also, does it belong to the equity market? What about corporate credit? What about treasuries? In any case, you take a look at how we're closing up today as the bells ring. You take a look at the S&P 500 up 0.5%, not quite at a record high. We are a breath or so away, that record high from January 2022, just under 4,800. We'll see if we get that by year end. You take a look at the NASDAQ composite up about 0.6%. And the Dow Jones, of course, this hit a record high last week, but that index, Tim, just about unchanged on the day.
All right, well, peeling back the layers of the S&P 500, you had 293 stocks move higher in the S&P 500, 209 moved lower, 19 stocks on the Dow moved higher. Well, we saw 11, Scarlett, move lower on the day.
Yeah, so definitely an upward bias here in equities. Let's take a look at the sector performances right now. Media and entertainment, that's your Netflix, that's your Meta, boosting that group up by more than 2%. Food and staples, these are retails, names, and they're up by 1.7%. I just checked Costco, continuing to build on recent gains following the special cash dividend that it announced. Retail overall gaining by 1.6%. On the downside, you have tech, hardware, and equipment losing 2/3%, autos and components down about 0.5%, and banks losing 0.4%.
All right, well, because I'm solo in the radio studio this afternoon, I got the gainers and the decliners.
Wow.
I want to start, no shortage of companies to pick from. We got some interesting and notable moves all around them. I want to start with U.S. Steel. Shares finishing the day higher by more than 26%, Katie. Soaring to the highest intraday level, at least since 2011. Some M&A news here moving the stock higher. Nippon Steel agreeing to buy U.S. Steel for $55 a share in cash and an equity value of $14.1 billion, plus the assumption of debt for a total enterprise value of $14.9 billion. We should note that Senator John Fetterman, Democrat of Pennsylvania, he actually vowed to block the deal. He called it, quote, outrageous, and said it's another example of hardworking Americans being blindsided by greedy corporations willing to sell out their communities to serve their shareholders. He said this in a post earlier today. Though So not seeming to move the stock, the regulatory concerns there at least. And then shares of Adobe also finishing the day higher. More M&A news, but this about a deal not actually happening. Shares of Adobe finishing higher by about 2.5%. The company agreeing to walk away from its proposed acquisition of the startup Figma. This coming from regulatory opposition, particularly in the European Union and the UK. It was a $20 billion deal. Adobe is going to pay Figma a $1 billion termination fee. Analysts, though, saw the termination as a positive for Adobe, and Barclays actually upgraded the stock in the wake of that. And let's get over to decliners and talk about Apple. This is a story that I've been obsessed with. I talked about it with you guys last hour, spent some time talking to Charlie Pellet about it. Just checking in on shares at the end of the day, down about 0.8%. This after the company said it's going to be pulling those latest versions of its smartwatch from shelves ahead of the holiday season as a result of this ongoing patent dispute. Shares fell actually as much as 1.6% earlier in the session. And then SunPower Corp finishing the day down by double digits today. It plunged the most ever intraday, down more than 31%. Breached a credit agreement and said there's, quote, substantial doubt about its ability to continue operating. If SunPower's lenders demand immediate repayment, the company wouldn't have enough liquidity to meet its obligations and pay its liabilities, the company said. Quote, as such, substantial doubt exists about the company's ability to continue as a going concern.
You know, you mentioned earlier, Katie, why not corporate credit? That's why.
Yeah. Why not?
Because of possibilities like that. And people don't know how to pick winners and losers. They're not doing the homework on every corporate bond.
It's a good point, and definitely something to keep in mind, because the point that we've been talking about is that even though interest rates theoretically coming down next year, they're still super high. And on that note, let's take a look at how the bond market is faring today. You did see a little bit of a sell-off. Of course, the narrative has been this big bond rally that we've seen, especially in the wake of Jerome Powell last week. But a little bit of pushback coming from some of the Fed speakers in the wake of Jerome Powell. That's not really making a dent in the stock market, as we've been discussing, maybe more so in the bond market right now, but we're talking about pretty small moves overall. The 2-year yield up just about a basis point. You go out to the 10-year up about 3 basis points. So nothing major here, but I did want to bring us some of this Fed speak. Of course, John Williams kicked us off on Friday saying that they're not really discussing the timing of rate cuts. That, of course, was one of the big headlines coming out of that press conference on Wednesday. And then Loretta Mester coming just today saying that the financial markets are a little bit ahead when it comes to rate cuts. You think about the Fed's dot plot at 75 basis points of cuts next year, the market at 150 basis points. Maybe that's more than a little bit of a goal.
You know, I was looking at the Eco Go function on the Bloomberg, and you pick central banks on the drop-down menu to see which Fed speakers are coming up to speak. And last week there were only 2. You had Goolsbee, and then you had Bostic speaking again. But they've added a couple more names. Tom Barkin will be speaking tomorrow, and actually Austin Goolsbee will be speaking a couple of times in the next few days. So more opportunity to push back, walk back, talk back to what Jay Powell had indicated on Wednesday. Yeah, but it seems like markets have decided what they want to do. And Katie, I think you make a good point that the equity market has absolutely ignored any of this so-called pushback. So I'm
because
kind
they're
of
looking for the Santa Claus rowdy.
Exactly. And you know, they're hearing what they want to hear right now. And I think it's really notable that we've had, you know, it hasn't been super forceful, but it's been notable that, you know, Fed speakers have come out and said this, though. You know, Mike McKee making the point over the weekend in a long post on X that Twitter, whatever it's called, that I retweeted. You guys should check it out. That talks a little bit about, like, kind of goes into how Jay Powell answered some questions and said, you know, what these Fed speakers are saying in the wake of this is not that different than the way that he answered some of the questions during the press conference.
But people hear what they want to hear.
Exactly. That's the important point.
And I did see that post, and I thought it was really important context. And to the point on the timing of rate cuts, definitely. But it was also the fact that Jerome Powell had multiple opportunities to push back against the easing in financial conditions. It didn't come. And I mean, at this juncture, you think about how far markets have moved. To not push back really seems like endorsement.
You know, financial conditions, I'm always thinking about this. Are they a reflection of policy, or do they drive policy? It feels like they do both, in which case it's just the circle that goes round and round.
So what are the catalysts that we have between now and the end of the year? We have these Fed speakers who are being completely ignored when they come out and do make comments. But what about corporate earnings and, you know, hearing from FedEx tomorrow or Nike later this week? Does it give us an idea of the consumer? Does it give us an idea of the economy? FedEx certainly will do that. But is it actually anything that moves the needle, Katie?
I mean, you think think about, too, some of the real-time data that we're going to get on the strength of the consumer over the holiday period. Of course, all of the travel data as well. But in terms of anything that's really going to alter the course of this rally, of this market, I don't know, you guys.
I mean, there is PCE coming up later this week, and that will certainly be important because that is the measure that the Fed really watches. It's its favorite inflation indicator, but there's a long time between that PCE and, of course, when the Fed speakers really come out in force once again and when most of the market is back participating again, too. So it could be easy come, easy go.
Wouldn't it be nice, though, if we could all just chill out, you know, just like ride
Maybe
it,
Fed speakers should come out and say that.
Yeah, like, guys, just calm down. We'll talk about this in January. Don't worry about it.
Not going to happen.
I don't know.
Not going to happen between now and then. Maybe. I don't know. I think next week is going to be pretty chill.
Well,
I think so.
Tim, we have to leave you now.
I know. Are you worried? Are you worried about me?
You singular.
I'll be okay.
I'm worried about you.
I will be okay. Do not worry about me. Hey, that is going to do it for our Beyond the Bell coverage. Hey, thanks for letting me hang out with you guys on this day when I'm all alone in the studio. Our cross-platform coverage of the market close on Bloomberg TV and radio, Bloomberg Originals, and YouTube. Meantime, catch us tomorrow, same time, same place.
All right, much more coming up ahead, including on the flurry of M&A activity that we're seeing. This is The Close on Bloomberg. All right, trading is finished on this Monday. This was the final Monday for the financial markets in 2023, and it ended with a rally for the S&P 500 up about 0.5%, not quite a record high. We'll see if we get there in the next week and a half or so. You take a look at big tech doing a little bit better. The Nasdaq 100 up by about 0.6%, even though you saw a little bit of a sell-off when it comes to the bond market. 10-year Treasury yields up about 3 basis points. Of course, we've been talking about this huge rally that we've been seeing in the bond space. It seems to be stabilizing right now, though. You take a look at 10-year yields still below 4%. And you take a look at the Bloomberg dollar, pretty much unchanged on the day. A little bit of a bummer. We'll see if it moves tomorrow. Let's talk about some of the individual equities, though. We've been keeping an eye on VF Corp all day. Of course, the retailer falling victim to a cybersecurity attack that is impacting its ability to fulfill its orders. It's still figuring out the scope of this attack. Wall Street seeing that as not good news, down almost 8%. Meanwhile, it is an M&A Monday. Geez, a lot of words there. And you can see that U.S. Steel absolutely rocketing higher after Nippon agreed to buy it for $55 a share in cash. That's boosting U.S. Steel by about 26%. It's actually also boosting Cleveland-Cliffs. This is interesting because remember, Cleveland-Cliffs had tried to buy U.S. Steel. It lost that bid, but in the wake of this finally being announced, it's going to aggressively pivot into share buybacks. Wall Street cheering that decision, shares up about 10%. And finally, Apple. Of course, the big news there is that they lost a patent case and they're going to stop U.S. sales of the latest version of their smartwatches. Shares only off about 0.9%. And zooming back out from the individual names, of course, one of the big stories over the last 2 months has been the broadening out of the rally that we've seen. And this next chart really shows that nicely. You take a look at financials, at real estate, basically the breadth that you're seeing, the percent of members that are trading above their 200-day moving average, Scarlett, for both financials and these real estate stocks. That's about 90 to 93%. So you talk about breadth, and really a lot of this rally had been led by the Magnificent Seven for 2023, but heading into 2024, a little bit of a different setup.
Yeah, people are seeking value, and perhaps they're finding it with those financials and those real estate investment trusts. All right, well, we also are seeing people seeking value, companies seeking value in U.S. companies, because there's been a flurry of M&A on what's likely to be the last major day for deal announcements in 2023. The biggest, of course, was Japan's Nippon Steel buying U.S. Steel for $14 billion. This is a move that'll create the world's second largest steel company, the world's biggest outside of China. Bloomberg's Joe Do reported on this transaction, and he joins us now. Joe, before we get into the ins and outs of the actual deal, one thing that's notable, Katie mentioned that Nippon will pay $55 a share in cash, but we don't see U.S. Steel trading at that level. It rose to $49.59. How confident are investors about this deal actually getting through?
Yeah, I think it's the right question. I think straight to the point, investors are pretty sure that this deal is going to go through. When you look at the antitrust concerns that you had, especially with Cleveland Cliffs, it doesn't seem antitrust is really an issue here with Nippon. Nippon did not have a real footprint in the United States and the United States market, so it doesn't seem like there's a lot of concern around that. I think if anything is in the back of investors' minds, it is the question of a CFIUS, because this is a foreign company that's buying a U.S. company, so it just has to go through the CFIUS review. And of course, you know, you've had a number of politicians come out today say that they are not supportive of the deal. Senator Fetterman said he would try to block the deal. And of course, the United Steelworkers, who have the right to make a bid for the company now that the company has been bid for, have also said they don't like Nippon. So I think this is in the back of investors' minds. But as you say, I mean, it got up to $50 a share today, which suggests that probably going to be some smooth sailing, although you might get a few bumps along the road before this thing is closed.
Well, talk to us about potential antitrust concerns, because, of course, you did have the United Steelworkers coming out really urging U.S. regulators to scrutinize this deal. Should we expect some of these regulatory concerns to come up to the surface?
Yeah, I mean, it's hard to know exactly, but I do think, you know, CFIUS is going to look at this. They look at all of these deals of a foreign buyer buying a domestic producer. You know, sure, you're going to have politicians coming out and wanting more scrutiny. You know, but at this point, there have been no analysts or lawyers out there saying that they expect that this won't go through. Listen, I spoke to the CEO of U.S. Steel this morning. I also spoke to Nippon. Both of them expressed a lot of confidence that this deal will go through. Nippon said, listen, we have full confidence because the relationship between Japan and the United States. Nippon is not new to this market. They've had a trading arm in the United States for a while. They've done some value add in the United States. So it's not like they have not been in this market before. And of course, U.S. Steel, listen, part of the deal was everybody coming through and doing their due diligence. And U.S. Steel apparently had a number of different bidders. And part of agreeing to accepting a bid was that they expected that all the regulatory stuff would go through. So it does seem like U.S. Steel has a lot of confidence in this as well, given they ultimately chose Nippon.
Yeah, so I want to go back to what you were saying about the steelworkers and the union, because we know that they did like Cleveland Cliffs' original bid for U.S. Steel, but that was something that U.S. Steel did not want to go forward on. And it's an unusual arrangement in which the U.S. steelworkers have some kind of right here, too. They're able to block deals, if I understand that correctly, and they were willing to transfer that right to Cleveland Cliff, their ability to approve the deal, had that gone through.
So they can't block the deal, but they do have the right to make an offer for the company that is better than the offer that has been accepted. And they have the right to transfer that offer to somebody else. And so it had been expected that whenever a bid was made, if the winning bid wasn't Cliffs, that they would probably transfer that right to Cliffs and give Cliffs the right to make a better bid.
I see.
However, when Cliffs came out today and said that they were doing a share buyback program, they also said good luck to U.S. Steel and to Nippon for closing their deal, which seemed to signal that maybe they're not going to make that bid, but we'll have to wait and see.
So what other recourse do the U.S. steelworkers, the union, have?
A lot of it is wait and see. I mean, that's the one thing they have in their contract is their right to make that bid. Obviously, listen, I spoke to David McCall this morning at 6:30 in the morning when the deal was first announced. He said, listen, the first call I got was at 6 a.m. this morning from the CEO. Obviously, he was not happy. It was a voicemail that was left by him.
Ooh,
Dave Burritt confirmed that to me as well. But listen, they're obviously not too happy. They've been out. They've made a strong statement. You've now seen both U.S. senators from the state of Pennsylvania come out and make statements. I mean, you start putting these things together, and it does seem like they're drumming up some attention on Capitol Hill to bring attention to this deal. But in terms of like legal actions that they can take, the only action they can take is making their own bid for the company as we understand it.
And so it was interesting that this deal really caused the entire space to rally. You take a look at the S&P composite steel index having a great day. Cleveland Cliffs, of course, they announced a buyback plan that certainly helps. But Olympic Steel, et cetera, some of their other peers rallying as well. What's the logic there? Is that a thought that there could be more M&A in this space, or is something else going on?
Yeah, I mean, I don't want to get too much into speculation because mostly I'm just doing the reporting, what people are telling me. And what people were telling me today is like, probably don't read too much into a broader movement in all the steel names. Sure, you probably get the chatter in the market. Well, if this happened, maybe somebody else is next. I think that's typical in any space. Like, well, if this deal happened, who would be next? But really, there was nothing fundamental that changed in the steel market today. And the steel market has had a rather difficult year. But it's held up pretty nicely. I mean, we've talked about that in the past, right? That everybody was worried that things were going to get really bad. And ultimately, things have been just fine. I don't think fundamentally anything's changed. There's a lot more attention on the steel industry because of this deal. Steel stocks in the U.S. typically are traded as more speculative stocks. I think that's an important thing to remember here. So looking into the day-to-day moves of steel stocks is not necessarily not necessarily meaning anything. It could just be people making different bets on the market.
Okay, I'll calm down. Joe Doe, great to speak with you. Really appreciate your time. You take a look at shares of U.S. Steel currently, rather finishing the day 26% higher. Now coming up, markets still digesting the Fed's latest decision. We'll discuss the parade of pushback from Fed officials next. This is Bloomberg. Well, Fed officials in recent days pushing back against bets on aggressive rate cuts next year. And who better to discuss than Bloomberg News chief macro markets correspondent Liz McCormick joining us in studio. And they're pushing back on aggressive rate cut bets that were really incited by Jerome Powell himself. Just talk us through what your sources, the investors, the analysts that you speak to are saying about both Powell's performance and then the pushback that we're seeing.
Yeah, I mean, some of the investors are saying, as far as Powell's performance, like, I'm baffled. Like, what was he thinking? Then again, like, Priya Misra emailed me, who's super smart, and said, I get it. You know, he thinks a soft landing. He wants it. And she said it was a smart move, that there's risks. But I think more people are like, did he really mean to, ease financial conditions so much, And like you said, there's been a plethora of officials that have come out since. And it's like someone was saying on Twitter or X, there's the fifth official that came out and no one listened to them. So the market is just kind of not buying these, pushback from the other officials.
Market does what it wants to do. Is there any data that's going to come up? I mean, we've got PCE, and we know that that's the Fed's favorite inflation measure, but is that something that could provide a more concrete pushback against what Powell has said?
Yeah, in fact, I think that's the only thing because, like someone said, the genie's out of the bottle. Powell, laid the groundwork for the pivot, but it's the data. So now we know this Fed is still data dependent, so they can change their mind. So we don't really care what they all say. That's what the market seems. But like say PCE, which I'm not predicting, but is higher than expected, and then we have a December CPI coming later, and then say the labor market turns around. So I think that is the only thing that's going to do it. The actual data, because the sentiment is already leaned into the easing. I mean, we pulled back a little today, rates are up a little bit, but look at the 2-year yield, didn't move too much, right? So I think it's kind of embedded in the system, and we have to see the data kind of break it, say, oh, the Fed can't ease, inflation's too high or something like that.
What about the balance sheet? Because let's entertain the hypothetical that, okay, the Fed's next move is a rate cut. There's going to be multiple of them. But I believe he said last week that he's not planning on, or the central bank isn't planning on altering the QT program. How do you thread that needle, that communication challenge of, okay, we're cutting rates, but we're still running off the balance sheet?
Yeah, I'm so glad you asked that because that's like the wonky stuff that I love. And I thought it was so interesting because Powell, in this press conference, to your point, they have said, hey, we could cut, which was originally a surprise. We could cut and still unwind the balance sheet. He added a little more insights at this press conference saying, well, it also depends on why we're cutting. Like if we're cutting because the economy's not doing well and we're trying to really ease, then maybe, he didn't say for sure, then maybe the balance sheet can't keep unwinding. But if we're like so-called normalizing, where they don't want, say inflation's coming down and they don't want the policy rate to get more restrictive effectively by just staying there, then why not? Why can't we have the balance sheet keep going because we're just normalizing, we're really not easing, we're just keeping things steady. So I thought that was interesting. But you have a very mixed opinions on the street on many saying QT maybe goes all year or ends in the fourth quarter. Others saying, oh, you know, Fed's going to have to end QT in June. I think that's going to be interesting. But I was like, oh, he gave me a little more insight. I'm still not sure what they're going to do. But and I think Ira Jersey of our Bloomberg Intelligence was saying, yeah, you know, maybe they end QT in the first half. Many say the second half. So I think I keep wanting that to be the bigger story, right? Because we want to write about it. But I think, you know, we have to see how things play out.
At the same time, he keeps not wanting it to be a story because he wants it to be part of the normalizing process.
Right.
So it's kind of like, let's not talk about the balance sheet because that's just its own separate thing.
Be cool, guys.
Yeah, just be cool.
Just calm down.
I want to ask you about financial conditions because you mentioned sentiment, certainly leaning in one direction. Financial conditions feels really squishy. It's like a mix of sentiment and what, asset prices? And
right, it's asset prices, it's yield, it's a mix of different things like sentiment. So there are times when people say, you know, financial conditions really matter or they don't. And there's a lot of people questioning with the lag in monetary policy, how much does this easing just over the last month or so of financial conditions, will that really matter? So it is a little squishy, but I think, you know, the Fed has, you know, real-time indices that they're looking at financial conditions, so they definitely take it into account. So we have to look at it. So.
All right, and we certainly will. Liz McCormick, thank you so much for joining us. And of course, we're going to stay with the central banks because the latest will be the BOJ decision that is just hours away. Takatoshi Ito at Columbia will be joining us.
I'm Katie Greifeld. Let's take a look at how markets performed on the day, the final trading day, Monday of 2023. And it was a rally in the equity market. You had the S&P 500 up by about 0.5%, even though you did see a slight pullback when it comes to that bond rally. 10-year yields up about 3 basis points. The dollar pretty much unchanged. Of course, we had a lot of fireworks last week, taking a bit of a breather right now. Interestingly, you take a look at the VIX, trading with a 12 handle. We'll see what that happens to it in 2024. Maybe we get to the single digits. You take a look at the trend that's been developing. And then finally, we do have Bitcoin over there. It is a little bit of an updraft today, hanging out around $42,000. Overall, pretty quiet day, but gains, another broad risk asset rally, Scarlett.
All right, and of course, the backdrop to all of this is what's been happening with central banks, whether it's the Fed or now the Bank of Japan, because its policy decision is just hours away. According to a Bloomberg survey of economists, the consensus is for the BOJ to hold rates where they are as it awaits more information on the path of inflation. Sound familiar? Let's bring in Takatoshi Ito. He is Professor of International and Public Affairs at Columbia University. Professor, thank you for taking the time to speak with us. You are also a former member of the Japanese Prime Minister's Council on Economic and Fiscal Policy as well, we should add. I'm curious because we saw Jay Powell signal a Fed pivot last week, away from rate hikes and, of course, towards a rate cut. And markets really took off on that at the end of last week, and they continued to in equities today. So, of course, now you see the central bank officials walking that stance back a bit. What do you think will be the main communication challenge for the BOJ in a couple of hours?
I think if they were to change the rate today, the challenge is to how to explain and communicate why the decision was that. And I expect that would be very difficult, so they wouldn't change the rate today. But I think they would signal that more firmly that they will be ready to take the first step for normalization in January or April. They have said that they want to see the results of the wage hike spring offensive, which would take place from February to May, but we see the major results in March. So the natural guess is that in April, BOJ would be ready to change the rate. But earlier, the second scenario is that they could change it in January if the inflation expectation, as the survey of the policy board member, if the inflation expectation would be raised significantly in January outlook document, they could change it in January. I think the market went a little bit wild when the Governor Ueda gave the testimony in the upper house saying that there'll be a challenging situation from this end of the year to early next year. And the market took it as there is a possibility of changing the rate today because this is the end of the year. But probably that was not what Governor Weather meant.
So we're not going to get a rate change at this meeting, but potentially in January, potentially in April. Just talk to us about the sort of implications of that. Of course, it's been since 2007 since we've seen a move from the BOJ. What has this journey been like, and what does it signal about where Japan is going from here?
Yeah, so Japan is behind, as you see in the graph, that in the step of normalization, because the Japanese economy was late in the recovery from the COVID recession, and also a inflation rate was much lower than the U.S. and Europe. The peak was 4%, and as opposed to 8 or 10 in the U.S. and U.K. But the Japanese CPI inflation rate is now up to stay at above 2, 3 to 4%, depending on which measure you take, and that has been there for a year. So combining that with the inflation expectation, how the inflation rate would hold above 2 is a key variable to make the judgment. That's my view.
All right, Takatoshi Ito, Professor of International and Public Affairs at Columbia University. Thank you for your time. And we do want to bring you some breaking news. The U.S. and their allies agree to a Red Sea naval task force. This, according to reporting by the AP. We know that there was a meeting happening and finally getting a conclusion there. Again, U.S. and allies agreeing to a Red Sea naval task force. We'll bring you more information as we have it, but let's keep the conversation going now on the BOJ decision that we're counting down to and its impact on the markets. We'll do that with Win Thin. He is Global Head of Currency Strategy over at Brown Brothers Harriman. He joins us now. And let's talk about this in the context of dollar yen, because the yen, I mean, it has been strengthening against the dollar since late October, but it's been a pretty weak year for the yen overall. What are you expecting as we head into 2024, and how much of that hinges potentially on what we hear from the BOJ in the next couple of hours?
Sure. First of all, Kate, thanks for having me. It's always a pleasure. If we think back to January of 2023, one of the biggest consensus calls was for dollar yen to plummet on expectation that the BOJ would tighten, U.S. would go into recession, et cetera, et cetera. Obviously, that did not happen. What I would say is that the scenario has actually just been pushed out, say, by a year. It looks like the Bank of Japan is keying up normalization. I have to agree with, I think, your previous guest. I think January is a possibility, but I think April is probably more likely in terms of actual liftoff. Most of the BOJ officials have been talking about, waiting to see how the spring wage negotiations go before, making a clear decision on removing accommodation. So, again, Bank of Japan is such an outlier here, but with inflation already coming down, the economy's in a soft patch right now. I think it probably makes sense for the bank to hike rates later rather than sooner. That said, that is a change in terms of monetary policy divergences that should lead dollar yen lower. But I don't look for a huge move. Why don't I? Because if the Bank of Japan does tighten, it'll be very, very modest. I think the swaps market is pricing in something like 25 or 50 basis points of tightening over the next year or so. And that's really quite, to me, really quite a mild tightening cycle. That said, a lot of it's going to depend on what goes on the Fed side of the equation. And, that's where we can spend hours talking about what's been going on in the markets. But I think that's where the most mispricing is right now in terms of markets, and that's the Fed easing expectations.
So the Fed still in the driver's seat when it comes to the markets here. But talk to us a little bit about what this could mean for the bond market. Okay, maybe muted moves in dollar yen, but part of the reason why U.S. investors are really paying attention to the BOJ is that there's a lot of concern that Japanese bond buyers will be pretty much staying home. If we start to see some normalization from the BOJ, maybe they won't be soaking up treasuries in the same way that they have been over the past decade or so. How are you thinking about that?
Yeah, no, Katie, that's exactly right. I think what we've seen over the last, as you point out, maybe the last 10, 15 years is that Japanese investors have really had to chase yield abroad. And it's not just in the U.S., but also in the Eurozone and particularly in emerging markets. Anywhere where there's where they can pick up some yield. Right now, the 10-year yield and JGB yield, despite this sort of lift-off application, is somewhere around, I think, 65 basis points. It hasn't even tested the 1% ceiling yet. So if and when the Bank of Japan does pivot, and again, I think we're sort of a little ahead of ourselves right now, but even when it does, there will be certainly an inflection point. If JGB yields do go up, say the 10-year yield goes up to 150 or something around there, just a guess, that will change the calculus in terms of global capital flows. And that's something we have to all keep an eye on, especially as the U.S. Treasury has to issue more and more debt to finance these growing deficits. There's a question that's going to hang over us, I think, markets for a while. Is, there's just a ton of debt out there. Who's buying? Who's selling? Who's buying? Where are the flows going? And that's sort of to be determined, but certainly have to keep it on radar screen.
Wynn, I've always had a question here because we talk about the BOJ and then we also talk about dollar-yen level in the same breath a lot of the times. How much does dollar-yen, does that exchange rate figure into the BOJ's decision-making process? Is it looking at it carefully when it comes time to decide on interest rates? Yeah, absolutely. I do think that they're very good. As I pointed out earlier, the economy's in a soft patch. Q3 shrank. Q4 doesn't look that much better to me. Inflation's coming down. If and when the Bank of Japan hikes rates, we would see a knee-jerk drop in dollar-yen and a knee-jerk rise in JGB yields. And both of those are tightening monetary conditions. And I think that's, again, why the Bank of Japan has been so careful. They've tried to exit NERP or ZERP many times before, only to sort of slip back into recession. And that's why they've been so really, really reluctant to move too soon. They believe it's better to let inflation run too high for too long, rather than remove the combination too early and plunge the economy back in recession. So yes, they have a keen eye on the exchange rate and on the interest rates. Both of those would move, I think very dramatically in terms of tightening monetary policy when the Bank of Japan moves. And that's why they're really treading a very, very careful path. I also have a question for you about Kazuo Ueda, the BOJ governor. When he was named the BOJ governor, it was a little bit of a surprise to everyone in the market. They had anticipated someone else would be named, someone who had worked with the previous governor pretty carefully. Has Ueda proven to be unconventional, someone who does surprise the markets, or has he proven to be someone who sticks to the script? Well, the Bank of Japan has delivered a couple of surprises on yield curve control. One by Mr. Kuroda previously, back I think last December. And we got a surprise, I think, this past July under Mr. Ueda. So, in general, the Bank of Japan isn't shy about surprising the markets. But I do think at this delicate situation now where the economy is sort of in a soft patch, they really will tread carefully. A big surprise means big moves. And to me, a big moves would be sort of against what the Bank of Japan really wants to see. And that's an extremely significant tightening of monetary policy conditions. I would say the one surprise for me with Mr. Ueda is he's actually been more dovish than Mr. Kuroda, his predecessor, which I think is very fascinating. Again, we talked about back in January, we're talking about how the Bank of Japan was going to hike, combination, the yen would strengthen, and really we've seen a year of basically the Bank of Japan being on hold. Yes, we've had a tweak or two to yield curve control, but really pretty minor in the grand scheme of things. We're still at negative rates. For here, whereas every other central bank is pretty much been through with their tightening cycle. That's what's astounding to me, is that the Bank of Japan is held steady at negative rates as the rest of the world is tightened and is actually on the cusp of reversing. So there's a lot of moving parts in the global monetary policy story. There's no doubt about it. But to your point earlier, I do think the Fed is really the main driver right now. Yeah, and everyone kind of reacting in response. Wynn, really appreciate your joining us. Wynn Thin of Brown Brothers Harriman. And of course, the BOJ decision, we'll be covering all of that here on Bloomberg Television. Coming up, we're going to hear from Michael Sonnenshein. He is CEO of Grayscale Investments, about his insights on the Bitcoin ETF, the spot Bitcoin ETF, and the challenges that faces from U.S. regulators. This is The Close on Bloomberg.
Well, as the clock ticks down towards the potential launch of U.S. spot Bitcoin ETFs, the CEO of Grayscale is arguing that multiple issuers should be allowed to launch their products at once. I spoke with Grayscale's Michael Sonnenshein earlier today.
We will lower fees upon conversion. I feel like as optimistic as I've ever been about getting closer and closer to the GBTC uplisting based on the conversations we've been having with the staff around the mechanics that underpin spot Bitcoin ETFs. But we will have to wait until we get all the regulatory approvals before announcing what that new fee will be.
I take it to mean we'll apply at launch that lowered fee.
Yeah, the first day that we see GBTC uplisted to the New York Stock Exchange as a spot Bitcoin ETF should carry that new lower fee.
And why wait? Why not just lower fees now while GBTC is still a trust?
Well, right now our actually main focus is really just on the conversion itself. So one of the things that I think is so important in this conversation around spot Bitcoin ETFs coming to market is that the conversation has really graduated from really only focusing on that underlying spot market, which is really where we were spending our time with the staff, to now instead really focusing on the underlying guts and mechanics of getting the SEC comfortable with how these products would actually function in market. So this is priority number one for my team, for the firm, and obviously for hundreds of thousands of investors across the U.S.
JP Morgan, in a recent research report, wrote that speculation that GBTC will actually convert into an ETF, that's fueled a lot of this inflow. And as a result, $2.7 billion could exit after the fact as investors take profit. So that's the JP Morgan view. What's your response?
So my view and my team's view is that the arrival of GBTC as a uplisted spot Bitcoin ETF, as well as spot Bitcoin ETFs more generally, is actually the beginning of an opportunity for the advised wealth market in the United States. That's about $30 trillion of wealth that, by and large, has not had products that they can go into to obtain spot Bitcoin exposure. Now, as you said, GBTC has been a very popular investment vehicle for investors of all shapes and sizes to get regulated Bitcoin exposure, and many of them are doing so today, right? We've seen the discount on GBTC narrow considerably this year as investor optimism around its uplisting has continued to take place. But I think for us, we certainly see that there's a lot of pent-up demand in that advised community, and we do think that GBTC, as well as other products, will actually experience a lot of that inflow upon conversion, upon uplisting.
Are you preparing, though, for the possibility that the JP Morgan hypothetical scenario plays out and you do see substantial inflows after conversion?
There are multiple Bitcoin futures ETFs on the market, and we've been prepared for a world in which there are multiple spot Bitcoin products on the market. Ultimately, I do think investors should have choice when it comes to that, and the differentiators that I already know will be in play for GBTC are its 10-year track record, its billions and billions of dollars of size, and certainly its liquidity, right? There's hundreds of millions of dollars trading in GBTC already every single day.
All right, let's broaden things out now with Bloomberg's Kaylee Lyons, who anchors Bloomberg Crypto, among other things. And Kaylee, you actually had a chance to talk to SEC Chair Gary Gensler last week, and it was interesting watching the interview. It seemed like he didn't want to talk about crypto all too much.
No, he really didn't. Granted, I was talking to him at an SEC open meeting that related to new rules when it comes to treasuries trades, and that's really what he wanted to talk about. But I said, hey, look, this is something you're actively dealing with. You have a number of these spot Bitcoin ETF filings outstanding, so let's talk about it. And he did indeed talk to me about them. He always says that they can't prejudge anyone filing, isn't able to give many clues on timing, like, for example, whether everyone is going to get to go at once or not. What he did, though, is allude to essentially the Grayscale case, which, of course, is where the court found that the SEC was arbitrary and capricious in denying Grayscale's attempt to convert GBTC into an ETF. Gary Gensler essentially told me we had this court case and we do things according to our authorities and how courts interpret our authorities. And to me, guys, that was a pretty clear sign that the court is essentially telling the SEC how it has to move here.
So I'm curious, and Katie, I know you've been covering this. January 10th is the day we're watching, and that is the day we're watching because of why? One particular filing, or?
So January 10th is, I believe, the final deadline for the ARK and 21 shares Bitcoin ETF application. As we count down to that, Kaylee, of course, there's been a lot of optimism priced into Bitcoin's price, if we can call it that. But when you're speaking to people on Bloomberg Crypto, when you're talking to investors, et cetera, has the spot Bitcoin ETF, the potential launch, already been priced in, or what would this actually mean for the market?
Well, a lot obviously has been priced in. You now have Bitcoin trading back above $40,000, a level that is pretty significantly higher than where it was to start the year. So we've seen quite a rally, and sure, a lot of that may be priced into the Bitcoin price. What I'm hearing more and more, though, is how actually these spot ETFs could factor into asset allocation, how it could actually mean that these crypto assets are more readily available for just regular institutional asset managers to consider putting into a portfolio. That seems to be increasingly the conversation because, yes, since BlackRock dropped that filing several months ago, this market has essentially been betting that if BlackRock's doing it, this might be something that actually happens. But I think it's really interesting, and you brought it up there with Michael Sonnenshein, the idea that is there room for everyone? We're talking about a multitude of filings and potentially ultimate products here. Is everyone going to be able to draw in significant inflows? Or even if some of these products get approved now, are they still going to be in existence a year or two down the line? Is demand going to be strong enough? And I think we're just going to have to wait for the answer to that question.
Yeah, and I guess the question then extends to once these Bitcoin ETFs are approved, if they're all at once or one by one, what happens to some of the companies that have become proxies for Bitcoin ETF? I'm thinking MicroStrategy, Coinbase, or any of those other companies that have seen their shares move up and down with Bitcoin's price.
Yeah, that's a really good question, Scarlett. Actually, I might borrow that and use it because Michael Saylor of MicroStrategy is joining us on Bloomberg Crypto tomorrow at 1 p.m. Eastern time. So I'll definitely be sure to ask that. But yeah, it may just really change the way that crypto is traded in the market right now. Obviously, this is a very volatile asset class by and large, Bitcoin in particular. Maybe less so now, but it's going to be really interesting as well, considering Bitcoin, of course, is by far the largest of these digital tokens, drives a lot of the volume. What happens to all of the other altcoins out there that aren't going to be turned into spot ETFs, and how does that differentiation in terms of being able to access it or indirectly access it going to mean for wider crypto trading?
All right, Kaylee Lines, great work. Thank you so much. Bloomberg's Kaylee Lines, of course, host of Balance of Power and also host of I was going to say ETF IQ, but you're the host. That's us. Okay. Of Bloomberg Crypto. All right, still ahead on The Close, what investors need to watch for tomorrow's trade. This is The Close on Bloomberg. The last market Monday is in the books for 2023, so let's look ahead to tomorrow on Tuesday. We've got the Bank of Japan, a big rate decision.
Yeah, that coming overnight, and then you tune in 8:30 a.m. New York time tomorrow. We got U.S. housing starts, again, trying to piece together more information about this very strange housing market.
Right, in which there's a lot of demand and virtually no supply, which is why everyone's turning to new construction. And then at 8:45 a.m. before the market open, our David Weston will be speaking with the CEO of Bank of America.
Yeah, big conversation. It's going to be interesting to tune in there. And then after the bell, earnings season is not over. We're going to get that after the bell tomorrow with FedEx taking the stage. And an important check, of course, when we think about the health of this consumer.
And what they're saying about demand at this moment with the holiday shopping season. That does it for us. Balance of Power is up next.